Hi, everyone. I'm Susan Winkler, Vice President of Metro Hartford Alliance and Executive Director of the Connecticut Insurance and Financial Services. Welcome to day 2 of the first conference on climate change and insurance. Thank you, Commissioner Mays and the entire Connecticut Insurance Department team for recognizing how this important topic touches all of us, consumers and insurers alike. Climate change demands action, whether we look at ways to take on the mitigation or embrace resilience. It allows for new ways of thinking. And even as important, it creates job opportunities and spawns innovation in products being developed by some of the companies right here in the insurance capital of the U.S. Today's panel includes some of the most foremost insurance and climate change experts who will discuss paying for resiliency, insurtech and innovation, and social justice. Climate change discussions are not new, but looking through the lens of insurance might lend you a new perspective, and we hope that it does.
Hi, my name is Katie Dykes, and I'm the Commissioner of the Connecticut Department of Energy and Environmental Protection. On behalf of our department, I want to congratulate Commissioner Mays and all the participants in the Connecticut Conference on Climate Change and Insurance 2021. Connecticut has long been a leader on tackling the climate crisis, and for even longer, we've been proud to be the home of the insurance industry. So it's very exciting to see both of our policy commitments coming together in this conference. We know how critical the tools of the insurance industry are to help protect families and businesses and communities from the unexpected, from the catastrophic events that we know will become more frequent now as a result of the acceleration of climate change. We also know how important the insurance products can be to assign value to taking the right steps and investing ahead of time in those types of infrastructure and other measures that will help keep our communities safe or safer in the light of the climate crisis. It's really critical that that we are able to bring this kind of a conversation together to learn about ways we can advance these tools and better utilize them to tackle this challenge. Governor Lamont has been a great leader in helping be a champion for reducing emissions and advancing climate resilience and adaptation. He convened the Governor's Council on Climate Change, which I'm privileged to chair, and which I know Commissioner Mays is a member of the council. One of the recommendations of our Governor's Council on Climate Change was to convene this conference in order to bring together so many important voices and help chart a path for how we can better position the insurance industry and utilize tools of insurance to protect communities going forward. So we're really excited about this conference. Thank you so much, Commissioner Mays and everyone, for taking the time to be a part. And we look forward to hearing the outcomes and wish you all well.
Welcome to the Connecticut Conference on Climate Change and Insurance, the panel on paying for resiliency. I'm Connecticut State Representative Carrie Wood, co-chair of the state legislature's Insurance and Real Estate Committee. I've spent much of my time as a legislator advocating for investments in renewable energy to help combat climate change, and I'm very excited to be moderating this panel. I'd like to thank the Connecticut Insurance Department and Commissioner Andy Mays for hosting this important conference on climate change. I'm here with a distinguished group of climate and insurance experts. I would like to begin by introducing the Washington Insurance Department Commissioner. Mike Kreidler is the state of Washington's 8th insurance commissioner. Since 2007, Commissioner Kreidler has chaired the National Association of Insurance Commissioners' Climate Risk and Resilience Workforce. In 2015, Commissioner Kreidler joined the Paris Pledge for Action, and his office became a supporting institution for the UNEP-FL Principles for Sustainable Insurance Initiative, the largest collaboration between the United Nations and the insurance industry. I can go on about Commissioner Kreidler's expertise in this field, but I just want to say welcome, Commissioner. and we'd love to hear an introduction from you.
Well, thank you very much, Representative Wood. And also, I'd like to extend my appreciation to Commissioner Mays for inviting me to this conference, and congratulations to him for hosting this first climate summit. I also want to recognize George Bradner. George has been around for a long time, like I have, and has been a stalwart supporter of raising awareness of the nexus between climate change and insurance for some 20 years. So as long as I've been involved with the NEIC, George has been there and helping. Our topic is paying for resilience, which is a different animal than paying for a loss. Paying for resilience is especially pre-paying for a loss. It's an investment in lowering the risk for loss. Mitigation mitigation can be part of the equation that adds up to resilience. Climate mitigation includes economic opportunities, investing in green power, new construction methods, new technology. We encourage insurers to take risks over the long term without threatening their solvency through state sustainability and with green investments. Insurers have a big role to play in helping us to arrive in time to a net zero world. Their investment and underwriting decisions are key to helping us on this pathway. As an insurance regulator for Washington State, my job is to make sure insurers are adequately prepared for paying for losses. In addition, they have the responsibility to disclose to investors, consumers, employers, and regulators how they manage all material risks to their business, including climate change. Many U.S. insurers have been required since 2009 to report to the NEIC annually, and that about how climate change affects their business, and it is part of what we call the Climate Risk Disclosure Survey. We've since moved to encourage insurers to and equally accept TCFD framework for reporting, which is more universal among business, particularly banking, to have that framework for reporting. The Task Force on Climate-Related Financial Disclosure and Development developed a framework to help public companies and others organize disclosure climate-related risks and opportunities. For insurers, it is difficult to transition for insurers, it is not a difficult transition to TCFD reporting, which we are encouraging. There's a substantial overlap between the survey questions and the TCFD pillars. Mandatory TCFD reports for many industries, including insurance, is almost a foregone conclusion in the future. Thank you for this opportunity to participate.
Thank you very much. Next up, I'd like to introduce Liz Henderson. Liz is a catastrophe and climate risk specialist with 18 years of experience in risk analytics and strategic consulting for the U.S. P&C insurance carriers at Aon. Liz leads the Growth and Innovation Solutions team. Liz also leads the Climate Change Analytics Group for Aon Reinsurance Solutions, creating new analytical insights for climate change risk in the U.S. Welcome, Liz, and we'd love to hear your introduction.
Well, thank you for that, and thank you also for hosting this panel. With the work that I do with our clients at Aon in the insurance industry, it is such a critical discussion around how do we support the industry in order to meet the rising requirements around things like climate change disclosures, but also it's a critical junction for insurers to make sure that we are active participants and leaders in the transition to support policyholders, homeowners, and business owners, making sure that they have the understanding of the risks that they're facing and the financial support to rebuild and recover after a disaster. At Aon, we are really working to make sure that our clients have access to the most up-to-date and scientifically credible information in order to create data-driven decision-making around climate change. Data is such a key part in all of the different stakeholders and pressures that insurers are facing right now in order to meet the rising challenge that climate change brings to the industry. From quantifying far forward-looking climate change risk, to understanding how the energy transition from fossil fuel-based economy to more renewable economy, to pricing and underwriting products for their policyholders. Data underpins all of those different decision points for insurers. And our clients are really looking to be leaders in helping their clients withstand the volatility from increased natural catastrophes that climate change brings to their doorstep. So thank you for this opportunity and really looking forward to the discussion.
Thank you, Liz. Next up, we have Brian Garcia. Brian is the president and CEO of the Connecticut Green Bank, the nation's first state-level green bank. The green bank model is demonstrating how smarter use of public resources can attract more private investment in the green energy economy, reducing energy burdens on households and businesses, creating jobs, and increasing the deployment of clean energy. Welcome, Brian, and please start your introduction.
Great. Thank you, Representative Woods, for your leadership in moderating this panel. And also want to give a shout out to Commissioner Mays, George, and the Department of Insurance team. It's only befitting that as the insurance capital of the world, that the city of Hartford and the state of Connecticut host this important event that we're having here today. I'm looking forward to the conversation with my colleagues on paying for resilience. I wanted to start off by introducing the Connecticut Green Bank and providing an overview of the Green Bank model. Then I'll discuss the level of global capital flows towards climate financing going towards the two pillars of the Paris Agreement, mitigation and adaptation. And lastly, I'll introduce a recently passed policy in Connecticut that enables its green bank to go beyond reducing greenhouse gas emissions through clean energy to include environmental infrastructure where we can invest in climate adaptation and resilience projects. The Connecticut Green Bank is the nation's first green bank. It was created through a bipartisan act of legislation in July of 2011. We're a quasi-public agency, which essentially means that we use private sector disciplines to achieve public sector goals. You could think of us as an intermediary between the ambitious climate change policies of the state and the private capital markets we're helping try to attract to enable their investment in our economy. We focus on delivering social and environmental impact for Connecticut as opposed to financial profit. We're celebrating our 10-year anniversary and have invested nearly $300 million of public revenues to mobilize $1.9 billion of private investment for a total of nearly $2.2 billion of investment in Connecticut's green economy. We have a leverage ratio of over $7 of private funds to $1 of public funds, and we invest the public funds. We don't grant it out or give it away. We've helped deploy nearly 500 megawatts of renewable energy that's created over 25,000 jobs in our communities, reduced the energy burden on over 57,000 families and 6,000 businesses, especially within our most vulnerable communities. We've helped generate over $100 million in state tax revenue and will avoid nearly 10 million metric tons of CO2 causing climate change and helping to avoid $300 million in public health costs as a result of cleaner air. The Green Bank model is a public policy innovation. As we know, the Paris Agreement is a stool with 3 legs. First, mitigating greenhouse gas emissions to hold the increase in the global average temperature to well below 2 degrees Celsius. Second, increasing our ability to adapt to the impacts of climate change and foster climate resilience. And lastly, where green banks are a tool, making finance flows consistent with mitigation and adaptation. Green banks leverage limited public resources to attract and mobilize multiples of private capital investment. Given green banks provide a variety of tools, including credit enhancements, co-invest in projects or programs, support warehouses and securitizations, and we issue bonds with the goal of attracting and mobilizing more private investment in our growing green economies. Green banks are being developed at the local and state level across the country and at the national level around the world. Green banks are growing and an important tool to filling the financing gap for tackling climate change and enabling the energy transition because we de-risk markets for investment from private capital sources. So let's quickly turn our attention to the level of investment needed. The Climate Policy Institute did a study in 2019 on global climate change capital flows. Approximately $575 billion of climate finance occurred in 2017 through 2018. 93% of that investment, or $532 billion, was in greenhouse gas mitigation. 5% of that investment, or $30 billion, was in adaptation. And the remaining 2% of that investment was in multiple objectives like water and waste, land use, etc. Roughly half of the total investment is from the public sector, and a little less than half is from the private sector, with the majority of that investment, or about $310 billion, as project debt. So how much investment do we need? In a Center for American Progress study of the United States, they noted that we need $200 billion of investment a year in the U.S. in renewable energy and energy efficiency to mitigate emissions that cause climate change. A UN study states that we need $6 trillion a year to achieve sustainable development by 2030. These investment targets are equivalent to between $600 to $800 per person per year of investment. In Connecticut, that's between $2 to $3 billion a year. As the Green Bank helps mobilize $200 to $300 million a year from the $30 million of public resources we receive, that means we need to enable another order of magnitude of investment to achieve that target. In July of this year, Governor Ned Lamont led an effort for the bipartisan passage of legislation that would further expand the mission of the Green Bank beyond clean energy to include environmental infrastructure, which includes climate adaptation and resilience. We not only have the ability to issue 25-year bonds for clean energy, but we now have the ability to issue 50-year bonds for environmental infrastructure. We have access to state support to improve the rating of those bonds up to $250 million. And we're currently in a 9 to 12-month planning process to develop a comprehensive plan to identify areas of priority for private capital attraction and mobilization. As part of that process, we're seeking additional private resources, including continuing to issue Green Liberty bonds and developing Green Liberty notes. We know everyday citizens in Connecticut and across the country want a safe and secure investment, and what better than to issue bonds modeled after the war bonds of the 1940s, whose proceeds are invested to confront climate change. And we're seeking additional public revenue support from the federal government as well, including the Clean Energy and Sustainability Accelerator or the Greenhouse Gas Reduction Fund through reconciliation, a pool of $20 billion to support state-level green banks. So thank you for having the Connecticut Green Bank as a part of this esteemed panel on paying for resilience.
Thank you very much. Next up, we have Marissa Gillette. Marissa is the chairwoman of Connecticut's Public Utilities Regulatory Authority, also known as PURA. Marissa is the former Vice President of External Relations for the Energy Storage Association, the national trade association representing the energy storage industry. And in that role, Marissa served as the association's executive team, contributing to the organization's overall strategic vision and direction. Marissa, we're happy to have you here. Feel free to start your introduction.
Thank you, Representative Wood. I want to add my thanks to Commissioner Mays for hosting this important conversation, and I'm looking forward to continuing the dialogue with my esteemed panelists, both today and hopefully in the months and years to come. So as Representative Wood mentioned, I currently chair the Connecticut Public Utilities Regulatory Authority, which is the regulatory agency that has cognizance over issues with our electric, gas, and water utilities that are regulated in the state. They're frequently known in other jurisdictions as public service commissions or public utility commissions, but the one common theme here is every state has one. Every state has an agency like mine that has cognizance over these investor-owned utilities. And I think up until about a year ago, PURA, myself, and my colleagues had not really considered the overlap of the insurance industry with the regulated entities that we oversee. And so participating in this panel in the months leading up to this important conversation have really crystallized for me in particular the overlap that there are between the insurance and the energy industries. PURA has been undertaking an aggressive proceeding over the past 2 years. We're coming up on our 2-year anniversary mark of our equitable modern grid proceeding, really focused at correcting the long time underinvestment in our electric infrastructure. This is coming at a crucial time in the energy industry across the country and really across the globe, as we're dealing with issues of climate change and how our infrastructure needs to meet those challenges of today as we increasingly rely on it. One of PURA's proceedings under our Equitable Modern Grid initiative is particularly focused on reliability and resilience. In the energy industry, and I imagine there may be some overlap in the insurance industry, we're talking about major corporations, not just public utilities. These utilities have evolved into multi-jurisdictional, multi-sector, really conglomerates. And as a result, there's a lot of inertia in our industry. And so as we tackle this question of reliability and resilience moving forward, we're really trying to get the stakeholders to look forward. And I think there's a lot of overlap and lessons learned that the insurance industry can teach us. For example, all of the forward-looking modeling that you do in our industries today, in the electric industry in particular, our forward-looking modeling is often limited to the question of usage, customer usage, that is, and the demand for the product. While that is an important piece of the equation, we're often lacking the other piece of the puzzle, which is what are the externalities that the system is going to face? And I think without that piece, we're unable to internalize those risks. And I think that that's an important conversation that this panel has helped me begin to crystallize. And I'm really looking forward to the conversation today and sharing a few more thoughts on how I think our industries can come together to really combat the climate change issue that is facing us all with increasing urgency. So Representative Wood, thank you for convening this panel, and I will turn the mic back to you. Thank you.
Thank you. Next, we have Frank Nutter. Frank is the president of the Reinsurance Association of America, also known as RAA. Frank currently serves on the advisory board of the International Network for the Financial Management of Large-Scale Disasters and the RAND Center on Catastrophic Risk Management and Compensation, and also the University of Cincinnati's Carl H. Lunder III Center for Insurance and Risk Management Advisory Board. Thank you, Frank. We'd love to hear your introduction.
Thank you, Representative Wood, and I'd like to join the others in commending the department for the leadership in providing this summit, and specifically to Commissioner Kreidler. Commissioner Kreidler has been a long advocate for the industry to be more engaged in not only business practices but advocacy related to climate change, and has been an inspirational leader in that regard. I'd like to make just a few comments, if you will, about the insurance sector and resilience, and look forward to the dialogue about all that. I would start with a comment that the insurance companies tend to look at climate through the prism of extreme events. So hurricanes, wildfires, tornadoes, that's really the way the industry sees or looks at climate, if you will. And yet what I think we're facing is the question of whether or not the industry is faced with uninsurable communities because of the risk of climate change that is affecting not just individual structures but communities. I don't think that's me. I hope not. My point being that the insurance companies insure individual structures, and therefore looking at the community as a whole is something that is relatively new to the industry, with a caveat. And the caveat is that it's long been the case that the leverage point for looking at communities from the industry's perspective are building codes. What could be done in influencing building codes? And I commend the attendees at this program to visit the website of the Institute for Business and Home Safety, which has focused for a number of years on how to improve the responsiveness and resilience, if you will, of individual structures, and now is looking at how communities could deal more with resilience for the community as a whole. It's probably important to keep in mind that for the most part, public structures are not insured in the insurance industry. Roads and bridges and that kind of thing are not really insured by communities. Now, there are communities and community pools that insure structures, and that's another leverage point, if you will, for the industry. But it's not how the industry, for the most part, sees climate, since it sees it through individual structures and extreme events. So the industry is clearly, the reinsurance sector is looking at not only looking at developing financial products for green technology, so that in fact is facilitating, if you will. I'm sure that Liz, when she talks about Aon's initiatives with its clients, that's an important part of all that. And I'd like to touch on something that we'll come back to, and that was when we looked early this year about where the leverage points were at the federal level for getting investment in resilience. We looked at the infrastructure package that the Congress is considering, perhaps the reconciliation package, and notwithstanding all the difficult politics around those things that are going on, the reality is there are opportunities there. And I think what we'll see coming out of that is the federal government putting much more money into mitigation and resilience initiatives at that level. We also proposed, and hopefully we'll see passage in all that, the idea of community resilience zones, if you will, identified using FEMA's Natural Risk Index, which looks at vulnerable communities, people that are vulnerable from an economic point of view, and people in communities that are exposed to disasters, climate-related disasters. And the idea which we promoted is that we could build upon the idea of the Build America bonds, which were used after the financial crisis to encourage investment by the private sector into the economy. This proposal has a feature that encourages the private sector, including the insurance sector, to invest in municipal bonds, as well as, we'll call them private bonds, but largely the kinds of things that Marissa was talking about, utilities and other kinds of quasi-governmental entities that we could see investments in that are featuring resilience as a component of all that. And I look forward to a fuller discussion of that idea as well. Thank you.
Okay, we're going to jump into some questions here. I think this would be a good question for Frank, Commissioner Kreidler, and Liz to comment on. Do you think insurance companies have a handle on the investment risks of climate change where we stand today?
The answer is no, and it's not their fault. It's largely driven because of the nature of the system that we have right now. We when you have some of the risk that is outside of the bounds of the insurance company, and they have a risk that they're looking at for a defined period of time, and you also have the potential of having government come in and bail out certain types of risk for certain individuals who most likely were not insured. Really complicate the picture. So I'm not pointing a finger at the insurance industry, the P&C industry. It's the nature of how we've structured it as much as anything here in the U.S. In particular, because it's not true elsewhere. I think moving toward something that looked a great deal more like an all perils policy would be one step. It's very difficult to do, but when you start to take flood and earthquake and other types of perils out of where there might be some kind of backup or a secondary type of coverage rather than an all perils policy, you're making it much more difficult for the insurers. So personally, I look at and say that if we could make some changes here, it's making that leap. It's not an easy one because we've become so addicted to the subsidy from public entities, which make it that much more difficult to predict losses. And we obviously have some real problems with being able to hold insurers accountable for risks when they have a defined period of exposure. Climate is something that is going to be a long-term ongoing. It's not a sudden event. It's a process of having to have the insurance for an extended period of time.
Commissioner Kreidler, let me associate myself with your comments, but and add a couple of things. If you look at the question about investment as where the companies commit their capital to support their underwriting, so the properties that they insure, it is a problem in certain areas where in fact you've got what Commissioner Kreidler refers to and the industry would refer to as adverse selection, is that the people who buy flood insurance are the ones with the highest level risk. So the industry is gun shy about writing flood risk as, again, looking at climate through the prism of individual extreme weather events. The idea of a multi-peril policy is worth an exploration to see if, in fact, that would provide the diversification of risk so that companies felt more comfortable writing, and this is a climate discussion, but writing earthquake coverage, writing flood insurance coverage, writing an all perils policy so that you had the benefit of all of that. The second thing would be to look at the idea of community-based insurance, that maybe there are financial products out there. Aon is actually an innovator in this area and looking at ideas for providing insurance for individuals, but written on a community basis and tying it together with resilience initiatives or mitigation level initiatives. If your question is focused on the investment portfolio of insurance companies, again, it's a real challenge unless you have some independent parties that are evaluating the climate exposure, however that would be defined, of municipal bonds, corporate stocks. It's very difficult for an insurance company to know what its exposure is in its investment portfolio without some kind of criteria that are established. And indeed, you have a number of the rating agencies that are looking at doing just that, which would in fact influence how insurance companies invest in their investment portfolio.
Yeah, I mean, if I might just add in another perspective as well, I think everything that you have said is exactly right, and highlighting a challenge that the industry really has between understanding kind of the extreme event risk, relying on the data and tools we already have in place to measure that risk, but now extrapolating that information to more forward-looking view where climate change is starting to change the behavior of the type of events that we're used to insuring, and being able to quantify how that change is going to impact losses that insurance companies might face. But we absolutely have a great product in order to be able to help communities and individuals protect themselves against these events as they occur. Insurance is designed, it has all the mechanisms, an insurance product has all the mechanisms in it to help individuals and communities invest in resilience, because there's an immediate reduction and a quantifiable reduction in the possible loss you might face when these events occur. And insurance is a great incentivizer to be able to say, we can understand the cost of risk today, and we can quantify what the benefit of this investment is. We can work with communities, we can work with individuals in order to create that framework. But the biggest challenge, I think, to being able to do that is that fundamentally, people really have a hard time understanding what risk they're actually exposed to, and have a hard time measuring and understanding the cost of the risk that they're actually exposed to. Individual homeowners really don't understand, what amount of flooding they might be exposed to unless they're in, a government issued flood zone. And those maps that the government provides are not necessarily based on risk modeling. That is more sophisticated in using the latest data. And so you're relying on outdated information. You might not have exposure to the data that can tell you how much hurricane risk, how much flood risk, how much wildfire risk am I really facing in this home, in order to make appropriate risk management decisions. So the industry really needs to keep exposing that information to individuals and to communities in order to then start the building blocks of how do we create other instruments, whether it's investment in risk reduction, infrastructure, and risk transfer products to help make sure communities can be resilient as natural catastrophes change in their behavior.
Representative Wood, if I could, let me comment on something Liz said, and I think we need to recognize that the Connecticut Department, Commissioner Kreidler, are under enormous pressure to balance consumer interest and affordability of insurance with increasing risk. It's a really difficult thing. If you're looking forward and you see, or even looking more recent, and you see recent events that are clearly creating a higher risk profile, and the insurance companies are coming in asking for premiums to reflect what they view as the risk profile. The department and Commissioner Kreidler are good examples of trying to balance that issue of affordability of insurance products for consumers with a climate that's changing and creating additional risk.
Yes, we're definitely experiencing that at the ground level with constituents' needs. I want to follow up on the modeling. This, I think, is directed at Liz and Frank again. What is the distinction between climate modeling and catastrophe modeling, and how are they being integrated for projecting the impact of climate change on insurance risks?
Yeah, that's a great question, and I think it's a really important distinction for people, especially all of the stakeholders in finding solutions to mitigate against climate risk, is really understanding what tools do we have at our disposal to quantify what the risk is today and how it's going to change in the future. The insurance industry, as Frank mentioned, when they think of climate risk, really, we are attuned to natural catastrophe event-driven risk. And the tools that we use to quantify what that risk is at an individual home, at the community level, for insurance portfolios, are catastrophe models. CAT models use historical observational data in order to build a set of scientifically probable events that may happen next year. They're really great tools to help us understand and quantify the impact that climate change has had already on the frequency and severity of natural catastrophes, and are the most appropriate tools to understand kind of near-term risk from climate change or weather-related disasters. The reason that these tools are so embedded in how insurers quantify risk is because they create very high resolution insights and risk location specific information around how structures are going to respond when they're exposed to flooding waters, high wind speeds, wildfire risk. We have detailed engineering information and studies that we can bring in to help be able to say one house might be vulnerable to a certain degree in a wildfire, but if the homeowner makes investments in things like hardy board siding, non-burnable roof material, we can use those CAT models to actually quantify what the benefit is from a loss perspective, and insurers can then use that information to embed it into their rates and into their underwriting guidelines. Now, those tools have been used by the insurance industry for decades to do exactly that analysis and have been used for underwriting and pricing decisions for a long time. But now we're being asked to bring in a forward-looking view of climate change. Climate change models typically rely on global scale information that are far forward-looking. So if you think about climate change data as, really trying to understand how does carbon emissions and carbon in the atmosphere affect global mean temperature change. And then we need to take, in the insurance space, we need to be able to take that information and link it to how does global mean temperature change impact the frequency and severity of an event. And then can we actually understand how does event behavior begin to change under different future versions of our environment? These are really complex scientific problems that we're trying to answer by bringing that forward-looking climate change data that's so critical in any kind of business planning or forward-looking view of climate risk into the tools that allow us to understand the impact of climate on pricing, underwriting, and portfolio management. So the difference really is in scale and timeline.
Representative Wood, if I could just supplement, Liz did an excellent job of answering your question. Part of the tension here is that the insurance business model is largely a retrospective one. It's built upon historical loss information, as Liz referenced. It's trended forward, usually with economic data, if you will, cost of living and that kind of thing. The climate models, of course, are very forward-looking. So finding that intersection that allows the integration of climate models, which have a spatial and temporal difference, if you will, than the insurance model is really the challenge of all of that. The modeling companies and companies like Aon that do modeling as well are doing a good job of trying to integrate what the science community believes to be forward-looking information and all of that. But it is a challenge, and it's a challenge, again, for insurance departments. Commissioner Kreidler could speak to this, about using models, if you will, using these analytical models that we're talking about into the rating process when you're looking at forward-looking information, which is evolving, if you will.
Yeah, thank you for that. Commissioner, did you want to add anything?
Well, thanks. Absolutely correct. I think it's really trying to get to that projection, and certainly mitigation and is one of the major steps, and that we've got to take looking forward. You can't build a risk model under static simulation that what happened in the past is what we can expect in the future. And as you look to the future and you take into account the climatic changes that are taking place and will take place, you've got to find some way to make sure that the insurance products that are being developed are being constructed in such a way that they really take into account those kind of changes, not just what's happened in the past, but what can happen in the future. I think the National Flood Insurance Program's maps that they develop are perhaps maybe one of the best examples. That they tend to be written on a fairly static previous experience world, and not nearly as forward thinking or looking as they need to be. That's the same challenge that insurance companies have, and it's got to be one that is not rewarded going forward, and it's one that regulators need to take into account as they try to price out make an assumption, I should say, as to the particular products being offered in a particular market that it's fair and reasonable for the charges that are being made. The other part of this is certainly making sure that you don't tie an insurance company just to here and now, particularly when it comes to some of the mitigation efforts that are required and some of the more solid construction that might be necessary. That as you build that into a new structure, you obviously increase the insurance costs, which are counterproductive to somebody who says, well, I'm taking all these steps so you don't have losses, yet you're charging me more. And I think it's trying to understand that you've got to have a longer look than just a 12 months period. It's got to be some way of being able to tie it. Now, how we do that is something that's going to require some real imagination to have products that go beyond the standard term as we would know it today.
Representative Wood, if I can add one more comment to that. I know you've got other questions. Several of us, including me, have referenced the National Flood Insurance Program and the kind of blunt instrument that the mapping that's done is for, particularly giving guidance to people about whether they're in or out of a flood zone. The FEMA has developed and putting into implementation October 1st what's called Risk Rating 2.0, which in fact gets away from the broad mapping that perhaps is misleading to people about where their flood risk is, since it's one of those classic examples of a climate-related extreme event. And Risk Rating 2.0 is designed to be more property specific about what the risk profile is. It's a really positive development.
That's really great to hear. Thank you for that. I want to move on to another question that is geared towards Chairwoman Gillette. What role can the insurance industry play in helping utilities and ratepayers invest in modernizing the grid and its infrastructure?
Representative Wood, thank you for the question. And I can try to tie this back to a little bit of what we heard, particularly in Liz's remarks just a few minutes ago, at the intersection of the affordability product and some of the modeling that you were talking about. And I think so far we've heard a lot about designing products for individuals or municipalities. But to take a step backwards, I think that there could be some overlap between the insurance industry and the utilities that are serving these states as a whole, and working to design products at that level, or being cognizant of what we're doing at the state level for this infrastructure that's serving all our constituents, to see how that can trickle down to the formation of these individual products and the affordability of those products. So what I mean by that is, if in Connecticut, for example, PURA has put a lot of thought into programs that work to decentralize the grid and thus increase the resilience of the individual homeowner or the individual municipality or individual community. I think that there's some overlap there with the formation of individual policies. For example, is there any benefit to your homeowner's policy if you have taken advantage of a state program that allows you to operate as a nanogrid? You have solar and storage, for example. And while that, providing for that resiliency through customers' electric bills may have an affordability impact there, perhaps it has an inverse affordability impact in the creation of these insurance products. So I think that there's like a relationship that we can explore there. And then to get back to your question about how in the inverse, how the insurance industry could help ratepayers afford these massive statewide investments in this infrastructure, I think that we could start by really benefiting from the modeling that you all have talked through. That I think, to be frank, the insurance industry is out ahead of where we are in the energy industry in terms of creating some of these models that are more forward-looking. So I've been a big proponent through some of our regulatory proceedings about looking at this question of forward-looking reliance on these models to create a new cost-benefit structure, so that the question isn't so much to the utility in today's age, is it cheaper to throw up a new pole and wire to correct for the outage that we have right now, or is it more cost beneficial long term to invest in a combination of undergrounding or some of these resilience measures that stand up to flood prone zones, for example. So I think that there's some direct and indirect ways that we can either take lessons learned from your industry, or we can have a more give and take between the two industries and get creative in the formation of these products. So it's a really great question, and I think this is just the start of that conversation. So thank you.
Commissioner Wood, can I comment on Marissa's question about that? In this proposal that I referenced in my opening comments about this community disaster resilience zone, there are really two types of bonds that we feel like could be targeted here to attract private investment. So think investment from insurance companies or banks or pension funds or whatever it would be. One of the traditional municipal obligations that would be more like the Build America bonds of the past, where the federal government would provide a financial incentive, if you will, a reward, if you will, for purchasing those bonds. But the other is what we would call private activity bonds. So utilities would be a good example of that. And the proposal is that communities could issue tax-exempt obligations to help finance private activities like utilities or water districts or school districts or those kinds of entities that are in these zones, if you will, these identified zones, where the bonds would have an attraction, if you will, because they would be attracted to be purchased in the private sector, but really for local projects. So the kinds of things that Marissa mentioned would fit well within this idea. So we're hopeful this will get included in the infrastructure package. If it doesn't, we're hopeful that the Congress will consider this as another feature of targeting public and private investment, if you will, into resilience projects like Marissa mentioned.
So the next question I want to ask is, how are regulators expecting organizations to measure, assess, mitigate, and disclose climate-related financial risks? And why are these financial disclosures so important? I'll open that up to the entire panel.
Well, I'll jump in as the only regulator here at the moment. Commissioner Mays isn't with us at this point, so let me say that we clearly want to have an understanding on several scores, not the least of which is the fact that we want to make sure that that the kind of investments that are being made by insurance companies are ones that are not going to be negatively impacted because of climatic changes, meaning when I started as insurance commissioner, and probably when Frank got started, a fairly solid type of investment were bonds for utilities built around electrical power generation that were based on coal. Now it's clear that coal-fired electrical generation is gone the way of the Edsel. It is not going to be around. It is not around any longer, and it was one that was doomed, not because of regulators, not because of the arbitrary decisions that we were going to move away from coal-based electrical generation, because of natural gas, which is also carbon producing into the atmosphere, but at a much lower rate than what we have. So what was a solid investment a few years ago became a really negative investment today. And we want to make sure companies are not tied to the kind of investment portfolio that looked good 20 years ago, but And some of these bonds obviously can be for extended periods of time, but much less. I would say that from what I've witnessed from the reporting that we've seen, which is part of why we do the reporting, that we're getting a much clearer picture that the industry is moving rapidly away from those kind of stranded investments that could really be problematic. But they've also got to move toward making sure that they're not in the game of insuring a particular area geographically, or that would, they're here today and they say, you know what, but this is a fairly short underwriting cycle, let's say 1 year, and if we don't like the direction we go, we'll either increase the cost or drop this market. And that's something that becomes seriously problematic. Like Representative Wood, I spent many years in the state legislature, and I can tell you right now, when you start hearing from constituents about having to pay an arm and a leg for their insurance over what they've paid in the past, it's not a pretty picture. Or if the insurance company says, we're out of this market, we're not going to write here anymore, that's a real problem. That will not be sustainable. So making sure we understand just exactly how and what the insurance industry is doing relative to both its underwriting and insuring practices, but also its investment practices, are critical to all regulators, but I believe to us as a society too.
Commissioner Kreidler, if I could comment on your comments. The NAIC, the National Association of Insurance Commissioners, really took a leadership role some significant number of years ago about disclosure related to climate. And Commissioner Kreidler and the commissioners in, I believe, New York and California, maybe others, have provided some aggregation and a release of that information. I think one of the concerns the industry has now is that a concern that we're on the cusp of a proliferation of data reporting to try and get this information. We support data reporting, but now the SEC, the Securities and Exchange Commission, is likely to require public companies to provide disclosure. The TCFD that Commissioner Kreidler referenced earlier is widely used in the European community and certainly by a number of U.S. companies, and reporting and disclosure, if you will. The Federal Insurance Office has taken a first step toward asking the question of whether they should be collecting data on all this. I think from the industry's perspective, what you want is some uniformity or some recognition of other systems of data reporting so that it doesn't become an administrative burden. But it is a valuable tool for the companies as well as the regulators to see where the industry has exposure, and for the companies to recognize that where their exposure is as well.
Great. Anyone else want to add to that?
Maybe I would just pick up there and say it's possible that the insurance industry, this is another way that we can seek to marry the insurance and the energy industries, because as an economic regulator of these utilities, we're putting an increasing reliance on data reporting to make sure that the return on investment that our ratepayer dollars are going into these resilience measures are yielding a quantifiable benefit. So, we're historically designing these grid resilience programs using what is called blue sky data, data that's collected from days like today where the sun's shining and there's no wind blowing. And the industry is trying to move towards creating these metrics that can capture more the resilience benefits to the individual consumer or the individual feeders or circuits. So if you're turning to your partners in state government at your regulatory commissions and asking them, what data are you collecting that could be, leveraged to create or to look at some more of these potential products rather than instituting new data reporting requirements, I think there's some, beneficial marriage that could happen there. So, that's just another plug for looking to work together moving forward, because I think there's a lot that you all have talked about already that I was unaware of from your side of the table. So look forward to learning more. Thank you.
Thank you. We will move on to the next question. Connecticut has emphasized the Justice 40 initiative, which promotes equity in federal investment projects while making our most vulnerable residents more resilient to the impacts of climate change. What types of financial innovation can the insurance industry provide to reduce the protection gap for those vulnerable communities who might find themselves uninsured?
Representative Wood, if I could jump in first in all of that, and I'm going to come back to what I've referenced a couple of times in this proposal for the community disaster resilience zones. The core of it is FEMA's National Risk Index, which has a social vulnerability component to it. It obviously features the 18 perils that it covers. We took that information and added to it census information, looking at income levels and housing stock, if you will, as a way to identify where you might target these investment bonds that I've mentioned a couple of times in socially vulnerable communities, as well as communities that are exposed to disaster risk. I think the point here is that there are analytical tools, we've used them, analytical tools available at the federal level, perhaps at the state level, but we've done data modeling, if you will, with all this, and can provide information at the census tract level, looking at social vulnerability, economic vulnerability, and where investments would make a difference in terms of disaster extreme event exposure by state, by, as I say, census tract, by congressional district. So we feel like there are tools, in fact, that can achieve the kinds of goals you're talking about in terms of social equity and looking at climate risk and extreme weather risk.
If I might join in too, I would just point out that one of the real challenges we're going to face as a society, and it can't be laid entirely. They'll play a role, but a very major role is going to be for society, because you're talking about buffeting against climate change some of our most vulnerable populations, and that's not an easy task to do. You've got to find some way of being able to, particularly now with the problems of the homeless population and housing in general. The last thing you want to do is to make it much more difficult for people to either rent or own a home and have a place to live other than on the streets, and that's a challenge. So that's going to be a societal thing. The challenge I think you have for insurance is to make sure that when they are prepared to stand behind their underwriting and say, we will insure this product, that it's not a short-term promise, it's a long-term commitment that they're there to make it. And the finances are not set up for that currently. Can we structure it in such a way so it is more long-term? The second is that they're going to make sure that you take care of that structure that's not necessarily making it cheaper and more affordable for the individuals that are struggling to find housing. So you've got to, it's going to be a real balance. I mean, the NFIP's real challenge here right now is that as they move toward a real price-based costing out of their product, it becomes clearer and clearer that they're pricing out the affordability of flood insurance to some of the people that need it the most, because they're the most vulnerable. At the same time, should they even be building there, and what kind of standards do they employ? And many of these structures have certainly been around for a long time, even before we were acknowledging the fact that climate change was on the path and breathing down the back of our neck.
This is Brian. I think my camera's working now. Forgive me all. I just wanted to follow the commissioner there. In the area of environmental justice, climate justice, social justice, energy justice, there's something that we call energy burden in the context of energy, which is the percentage of household income spent on energy. An affordable energy burden is no more than 6% of household income spent on energy. And our low to moderate income families can in fact spend 10, 15, 20% or more of their household income on energy, which makes energy unaffordable or creates an affordability gap. what percent of household income is spent on insurance is kind of a question, right? So, what is the insurance burden or protection gap for the most vulnerable? In Connecticut, thanks to the leadership of Representative Woods, we have policy definitions for vulnerable communities. In Connecticut, the insured value of coastal property is $754 billion, which is 66% of the state's total insured value. So that's more than $1.1 trillion of insured value. The question that I have is what's the value of uninsured property in Connecticut? What's the protection gap for vulnerable communities? If insurance is a mechanism to improve our resilience to the impacts of climate change, then how do we ensure that our most vulnerable communities have access to it? We have innovations in finance in the clean energy space that completely eliminates the energy affordability gap that I was talking about for our most vulnerable communities through a combination of incentives and financing that promotes what Chair Gillette was saying in terms of solar PV, energy efficiency, storage in lease structures. And when we build all that together, not only are we mitigating emissions, but we are improving the resilience to power outages for the most vulnerable. So it is upon all of us to ensure that, again, the economy we're building and how we confront climate change enables the most vulnerable to become more resilient and to benefit from it the most.
If I could supplement that, one of the things that we've advocated for as part of the National Flood Insurance Program reauthorization and reform is a voucher program so that people that own structures get a clear message about what the risk profile is, but if they are socially or economically vulnerable, that they would qualify for a voucher program. It's not uncommon in federal programs to have something like that, so that people can stay in their homes and not be shuttered out of their homes because of the cost of insurance. Certainly, I'm not familiar with what energy costs would be, but we do think that there is a way to solve the problem of sending the message of what the risk is through the insurance premium, but providing vouchers for those that really have economic need.
Great. I wanted to follow up with another question for Brian, but anyone else, feel free to jump in. Is there a role for green banks to work with the insurance industry?
I would say absolutely there's a role for green banks to work with the insurance industry. I think Frank has encouraged that with the Build America bonds and thinking about how we engage in our municipal bond markets to ensure that there are opportunities for insurance companies to invest and provide the necessary capital to invest in the infrastructure that we want to see. I was talking a little bit before about the Green Liberty bonds. So in Connecticut, we have the ability to issue bonds to support and finance clean energy improvements. We now have the ability to finance resilience and adaptations by issuing bonds up to 50 years. And we issue those bonds to the private markets, insurance companies, pension funds. We also issue them to citizens. We feel it's important to make sure that these bonds are retail accessible so that citizens in our economy can also confront the climate crisis through our system of capitalism. So there's absolutely opportunities for us to partner with the insurance industry, taking the lessons learned from both sectors and figuring out how we might mobilize more private investment in the green economy we want to create.
Anyone else want to jump in?
I might jump in quickly and try to build off of what Brian just said in response to this question, as well as how Frank ended that last question. In Connecticut, which I don't think it's a unique problem, a lot of our housing stock is not owned, it's rented. We have upwards of like 40% of our single family homes in Connecticut are rented, as a statistic that I heard recently. And I wonder if they're, listening to all the good ideas that have come out of the conversation today, there's an opportunity for, Brian and the Green Bank and the insurance industry to leverage those bonds and vouchers to kind of crack the nut that I don't think any regulatory energy commission has cracked across the country, and bridging that what we have never been able to bridge in terms of the lack of incentive for a landlord to act in making the individual housing stock more resilient, especially when it's their tenant who's paying, the energy bill. So perhaps targeting, a marriage of an insurance product, presumably the landlord still paying the insurance for, the property. With some, we've come up with all kinds of incentives to try to encourage the landlord to make the property more energy efficient or more energy resilient. So perhaps there's a way that, I think the Green Bank in Connecticut is not yet replicated to the degree it's been so successful in Connecticut, but we could certainly be a leader here in trying to show how the Green Bank and the insurance industry could come together to solve what is really an age-old problem of the landlord-tenant issue. So thank you.
Great. Last question I'm going to ask is, are there any opportunities at the national level to provide incentives for local communities to invest in resilience? And I'll start with Commissioner Kreidler.
Well, there definitely are, and I think we're going to start to see a great deal more of that take place, and it's going to be going to take a lot of hand-holding because you're going to, particularly when you deal with such issues as wildfire, which are much more of a peril, climate-driven peril for us here in the Northwest. When you start telling people that what they have to do with their own property, it sometimes becomes, there's some resistance, something like immunizations for some people, that there's this built-in resistance to it, not because they doubt the science, it's because I don't want to be told what to do. And I said, geez, it sounds just like my 3-year-old, but many years ago. But it is clearly one where we've got to start to build in the kind of incentives to communities, so you don't have the kind of isolated community like we did in Paradise, California, that can be wiped out by a firestorm that rushed through that area. We've been lucky, knocking on wood, we haven't had another one like that since Paradise a couple of years ago, because that's the kind of buffeting that we have to build into the system, and that means building the kind of open spaces, not having the people move to certain areas because they really like the trees and want them up close to their houses, and all of a sudden that's the biggest liability that they face. So you've got to build in the incentives. If you want insurance, this is what you're going to have to build in the way of accommodation, and there has to be a way of monitoring and maintaining those standards over time, so it's not one that erodes. But it's going to be, I listened to public radio just earlier this week talk about somebody complaining in Oregon, just to the south of us, about you're not going to take down my favorite big fir tree out front because that's why I love this house. And I'm going, well, as long as we hold on to those and there aren't any penalties associated with it, it's a problem. I think the penalties have to be, in many cases, tied. If you want insurance, you've got to make these kind of changes. And I think we've got to build it into society. And I think that's kind of what you got to do with the immigration, with the immunization crowd, and say, if you want to be able to go to the professional football game, you've got to have proof of that you have the vaccine. In this case, you've got to prove that you've buffeted your house enough and property enough against wildfire to allow an insurance company to come in and accept that risk.
Representative Wood, the comment I would make as well is that if you look to the tax code, the federal tax code, if you're looking for incentives for the states to work together at the federal level on this, that's why we promoted the idea of this Build America bonds as taxable bonds, if you will, but with a federal subsidy on those bonds to make them attractive for private investment. The second part were these tax-exempt obligations for private activity things, not unlike the utilities or school districts that I mentioned before. And the third proposal that we have as part of all this is that the IRS would, in fact, evaluate such bonds for purposes of the savings associated with lowering disaster assistance cost after these events, and use that as a tax credit that could be transferable, tradable, something that communities in issuing these obligations would get the benefit of a tax credit, if you will, that could be sold to help fund what they want to do. So I think there are a lot of ways to look at federal tax commitments, federal tax provisions to provide incentives for local communities and states to do the right thing in investments in resilience, but provide incentives for insurance companies, banks, pension funds, and others to invest in it.
And just building off of Frank's comments here, I think as we're all awaiting what's going to happen in Congress with respect to the bipartisan infrastructure framework or reconciliation, that if we look back, there are a number of things that we can do today or policies we can act on today. The one that comes to my mind is the Community Reinvestment Act of 1977. So in this context, what the policy is trying to do is to encourage FDIC-insured financial institutions, credit unions, community banks, state banks, regional, federal banks, to lend to low to moderate income communities, less than 50% area median income, moderate income communities, 50 to 80% AMI. So this is a tool that we have today. In Connecticut, we have a product that we call the Smarty Loan, which is to support the state's comprehensive energy strategy. And over the last 7 years, we've enabled $100 million of financing from our local community banks and credit unions to help homeowners improve their energy performance by putting insulation in the walls, putting solar on the rooftops, putting batteries in their homes, and becoming more energy efficient. And by using simply the strength of the Green Bank's balance sheet, the only thing we've had to do is to provide a second loan loss guarantee. We've only had to pay $75,000 in losses. So the idea that the state would pay $75,000 and the private sector would invest $100 million, those are the types of numbers we need to be moving towards to enable more private investment in the economy we want to see.
Anyone else? Great. Well, I just want to thank the team at the Connecticut Insurance Department for hosting this panel, and many thanks to the panel members for making this such a dynamic discussion. I know we could have gone on for at least another hour, and thanks everyone for joining.
Hi, I'm Richard Blumenthal, United States Senator for Connecticut. Very proud and excited to join this virtual conference organized commendably by our Connecticut State Department of Insurance. Thank you. And thank you to everyone who is participating in this vitally important topic that should really preoccupy everyone around the globe today. Obviously, climate change will affect the world that we leave for our children and grandchildren, indeed threatens the survival of our planet, not to mention lives and livelihoods, quality of life, the natural habitat and wonderful coastline that we often take for granted. So we all have a personal stake in this issue, and equally important, we have a national security interest in it. As a member of the Armed Services Committee, I can tell you our Department of Defense says that climate change is a national security threat. It creates the droughts, floods, natural disasters that in turn spawn hunger and anger that can lead to terrorism, war, and other calamities that affect our national defense and security. So we need to invest short-term, long-term, electric vehicles, rail, coastal resiliency, as well as water quality. These investments in infrastructure will bear returns, and limiting emissions, carbon emissions that affect the quality of our atmosphere and public health, as well as other pollutants and contaminants, are vital as well. There's a lot of work to be done. I thank the Connecticut Department of Insurance and all of you for sharing in this vital work, and we can do it if we have that determination.
Good afternoon. My name is Stephen Seitz, and I'm the Director of the United States Treasury Department's Federal Insurance Office. I want to start by thanking Commissioner Mays and the Connecticut Insurance Department for this invitation to address the Connecticut Conference on Climate Change and Insurance. The Connecticut Insurance Department has been a thought leader among the U.S. states in several areas of insurance, and I look forward to participating in this conference and discussing FIO's work in this important area. Federal Insurance Office looks forward to ongoing engagement with the Connecticut Insurance Department, as well as each state individually and collectively on climate-related issues. And FIO has begun this outreach to each of the states. While I know many of you are aware of FIO's mandate, I want to provide a quick overview for those of you who may not be as familiar with the Federal Insurance Office. The Federal Insurance Office has the authority to monitor all aspects of the insurance sector, including the extent to which traditionally underserved communities and consumers have access to affordable non-health insurance products. FIO also represents the United States on prudential aspects of international insurance matters, including at the International Association of Insurance Supervisors. In addition, FIO is authorized to collect data and information from the insurance sector and to analyze and disseminate data information, as well as issue reports on all lines of insurance except health insurance. Additionally, FIO's director serves as an advisory member of the Financial Stability Oversight Council. First, I would like to provide an overview of what the Federal Insurance Office is doing at the Treasury Department as part of our climate change initiative. I'm sure you are familiar with the President's May 20th executive order on climate-related financial risk, which articulates a plan to oversee and coordinate interagency efforts to assess and manage these risks to financial stability and deliver consistent, comparable, and decision-useful climate-related financial information to market participants. Pursuant to the executive order, Secretary Yellen, in her role as chair of the Financial Stability Oversight Council, has been engaging with financial regulators to assess the challenges posed by climate change. The executive order also highlights the important role of the insurance sector in this area. And the Federal Insurance Office looks forward to engaging with the state partners and stakeholders as we work on these climate-related issues, including those discussed in the executive order. Next, I'd like to turn to FIO's Request for Information, or RFI, on the insurance sector and climate-related risk. By way of background, the Intergovernmental Panel on Climate Change reported earlier this year that human-induced climate change is already affecting many weather and climate extremes in every region across the globe. Evidence of observed changes in extremes such as heat waves, heavy precipitation, droughts, and tropical cyclones, and in particular, their attribution to human influence has strengthened since 2013. The United States has experienced a dramatic increase in the frequency and severity of climate-related disasters, with a corresponding increase in economic losses over the last 40 years. Economic growth, combined with changing socioeconomic trends, such as urbanization and the migration patterns of individuals to areas at higher risk of climate-related disasters, are increasing the financial risk associated with the effects of climate change. As all of you know, the insurance sector has felt the impacts of climate change directly through the claims it has received from its policyholders. The effects of climate change also affects insurers through their broader role in financial markets. For example, the US life insurance sector is one of the largest investors in the US capital markets, with over $4.7 trillion in investments held in general accounts as of year-end 2020. As owners of significant amounts of assets, insurers could be vulnerable to potential decreases in asset values arising from the transition toward a low-carbon economy. As noted in the RFI, FIO intends to take a leadership role with respect to insurance as it works to implement the President's executive order on climate-related financial risk. FIO also intends for its climate-related work to provide an insurance-specific focus within Treasury's broader climate work. including working closely with Treasury's Climate Hub, which Secretary Yellen created to bring to bear the tools, capabilities, and expertise across Treasury to support the President's goal of achieving a net zero emissions economy. To that end, last month, FIO issued a request for information to solicit public input on FIO's future work on insurance sector climate-related financial risk. FIO intends to initially focus on the following 3 climate-related priorities. First, assessing climate-related issues or gaps in the supervision and regulation of insurers, including their potential impacts on U.S. financial stability. Second, assessing the potential for major disruptions of private insurance coverage in U.S. markets that are particularly vulnerable to climate change impacts, and to facilitate mitigation and resilience for disasters. And third, to increase FIO's engagement on climate-related issues, leveraging the insurance sector's ability to help achieve climate-related goals. The RFI also seeks input into how FIO's data collection and dissemination authorities can best be used by FIO in support of these priorities, as well as to monitor and assess the insurance sector climate-related financial risk. Access to high-quality, reliable, and consistent data will be necessary for accomplishing all 3 of FIO's initial climate-related priorities. FIO also plans to identify and issue recommendations on individual actions that can be taken by the various insurance sector stakeholders, such as insurers, policyholders, state insurance regulators, to address climate-related financial risk and facilitate the U.S. insurance sector's transition to a more sustainable and resilient future. We recognize at FIO that an effective policy response to climate-related financial risk requires an iterative approach, and we intend to work with stakeholders and adjust our work and priorities as our work progresses. I would like to note that the RFI buckets questions into certain categories, including first, on the executive order, second, FIO's initial climate-related priorities, third, on climate-related data and FIO's data collection and data dissemination authorities, fourth, on insurance supervision and regulation, fifth, on insurance markets and mitigation resilience, and sixth, and finally, on insurance sector engagement. The responses from interested parties to the RFI will help FIO assess and inform our work on the implications of climate-related financial risk to the insurance sector. I would like to strongly encourage everyone at the C4I conference to review the RFI and consider commenting before the November 15th deadline, as doing so will help inform FIO's work in this important area. As noted earlier, one of FIO's climate-related priorities is increased engagement. We are continuing to engage with insurance supervisors to address this important issue. Domestically, FIO is engaging with the National Association of Insurance Commissioners and their leadership, as well as the various state insurance regulators through their work on climate-related topics. FIO also looks forward to a robust engagement with the insurance sector after the conclusion of the RFI comment period. The insurance sector will provide a valuable and needed perspective on the specific challenges that climate change poses to the industry and how the unique role of insurers can be best leveraged against climate change. FIO is also engaging with other government stakeholders to tackle this important issue. As we noted in the RFI, FIO is engaging with the Securities and Exchange Commission and other members of the Financial Stability Oversight Council. On the international front, FIO is now a member of the IIS's recently formed Climate Risk Steering Group. We're also a member of the UN Sustainable Insurance Forum and the work of the Organization of Economic Cooperation Development's Insurance and Private Pensions Committee. All of these international organizations are increasingly focused on climate-related issues, and FIO looks forward to the continued engagement with these groups. Additionally, we're discussing climate-related issues with insurance authorities in both the United States and the European Union through the EU-US Insurance Project. Our team will be participating in the upcoming EU-US Public Forum on October 19th, which will discuss climate issues. We've also been engaging bilaterally with other insurance authorities. And of course, we are engaging with the insurance sector through FIO's Federal Advisory Committee on Insurance, an advisory body to FIO that provides FIO with non-binding recommendations on issues impacting the insurance sector. FIO looks forward to our work in this area and our continuing engagement with the insurance sector and other stakeholders to inform our work in this important area. I'd like to conclude by thanking again Commissioner Mays and the Connecticut Insurance Department for this invitation to participate in this important conference. Thank you.
Hello, everyone. My name is Josh Hirschman. I'm the Deputy Commissioner at the Connecticut Insurance Department. I'm very excited to moderate today's panel on innovation and climate change. We have some great panelists here today, and I'd first like to just thank them all for participating and dedicating their time to today's panel. I'd like to first allow them all to have a moment to introduce themselves, so I'll just start off with Stephen. Steve, go ahead.
Josh, thanks, and thanks for the invitation. I'm Steve Bennett. I'm one of the co-founders at the Demex Group. My background is pretty much all in weather and climate. So I was a meteorologist for a big chunk of my career, doing radio and some behind-the-scenes work in television. Was always told I had a face for radio, so they never really let me in front of the cameras. Around 2010, I shifted track from the sort of traditional weather work and moved into finance and insurance. I worked with Citadel Investment Group, which is a hedge fund out of Chicago, on starting up SIG Re and Newcastle Re in Bermuda. That was back around 2005 or so. So my career arc really focuses on linking business decision-making, business outcomes, business impacts to weather. And that specifically in today's day and age means linking those impacts to the effects of climate change.
Okay. Thanks, Stephen. Sabine.
Hi, everyone. I'm Sabine van der Linden. I'm the CEO and managing partner of Alchemy Crew. Alchemy Crew is a venture lab where we collaborate with large insurers, startup, scale-up grown-ups, and investors to identify and work on the problems of tomorrow and solve them with startups. I often say, why buy when you can partner with an ecosystem of great ventures? And my background is I've worked in insurance for over 25 years, starting my career at Lloyd's of London. I was a part of the team which set up Startup Bootcamp InsurTech in London. And then I was welcomed to build an accelerator as well in Hartford. And now I'm bringing back all those competencies we built over 5-6 years to bring it to the next level, to work with insurers to solve bigger problems such as climate change.
Great, thank you. Marcus.
Yeah, hello everybody. Thank you for inviting me. I'm Marcus. I'm the CEO of RiskX and also a professor for blockchain and artificial intelligence. My former career was in the insurance industry, and I worked for the whole value chain, starting by the broker, ending by the reinsurer. And now I'm focusing on systemic and emerging risks and how parametric solutions can be deliver a support for the whole industry with a special focus on captives and reinsurance companies.
So, Stephen, let's start with you. Let's discuss sort of the baseline question, and anyone can jump in when Stephen's had an opportunity to answer. But can you just define what climate risk is?
Yeah, it's a great question. And climate risk can mean a lot of different things to a lot of different organizations. So, I think in the definition that we're talking about in this context is really what it means to an insured either an insured business or an insured person. And the way we see this is that no one really experiences the climate or even climate change directly. What we all experience is the weather. So a hurricane, a tornado, a blizzard, a flood, those are all things that we're pretty used to dealing with, and that the industry has grown up around and really understands very well from the perspective of a natural catastrophe. What we have observed over the last decade or so, and what the science is telling us we will continue to observe in the decades ahead, are extreme weather events that may not meet the definition of a natural catastrophe, but still lead to significant loss, business loss in some way, whether it's damage to property, whether it is lost business in some way, whether it is an increase in cost to mitigate or recover from an extreme weather event. These are the same kinds of events that we talked about in natural catastrophes, with the exception of they're just not quite as severe. So extremely heavy rain events, extremely heavy snow events that might not trigger the definition of a natural catastrophe, but cause loss nonetheless. What we've observed over the last couple of decades, and what the science tells us we can continue to expect to observe, is that the nature of those events is changing. They are becoming more frequent, and the severity of them is changing in a way that the industry can sort of quantify and begin to build new protections around.
Okay, great. Thanks for that, Stephen. So, Sabine, you're working in the private equity, VC type space. What sort of solutions are you seeing to address these climate issues?
So there are various solutions, Josh, which are coming to market. And when the VC and the corporate venture capitalists look at climate change, they look at climate tech as potential options to solve some of those problems. We have seen over 20,000 ventures coming to market during the past 15 years. Within those, 6,000 have raised 180 billion in funding. And what you will find is during the past 5 years, 80% of that investment was made during that time, during the past 6 years. And so these companies include companies focused on decarbonization. They are looking at waste management, how we can reduce air pollution, which all have an impact on climate and the weather. There are solutions as well when we start looking at climate risks, solutions which focus on risks modeling, but also how we overall try to reduce and mitigate risks. So there is a big focus on that. But when you look at the top 5 business models that investors are focusing on their attention on at the moment, you will see that the movement from fossil fuel to renewable energy is a big topic, which would entail looking at electric vehicles, looking at how we look at food, how we consume food, how we use food, and how we waste food as well. So they are looking at food tech. They are, as I mentioned, renewable and energy tech is a big and massive area. How can we help oil and gas and energy companies to reduce the fossil they use, and so therefore the damage they make to the planet and particularly biodiversity? And also solid waste management and air pollution management solution are some of the biggest areas. And so the implication for climate risk is getting access to the data from those solutions, being able to mitigate risks through product prediction, and so therefore leveraging artificial intelligence and other algorithms, the overall prevention and risk, but also emerging risks as a topic which entail for insurers the design of new product and services long term.
Great. Hey, I guess I just have one follow-up on that, Sabine. Can you highlight any sort of products that you're seeing in the space of sort of diversity, equity, and inclusion and social justice? I mean, are you seeing, one of the conversations that's taking place is that climate risk is impacting different groups of people differently, and we're seeing protected classes be impacted at a higher level than other groups of people. So just wondering if there are any things that you're seeing in your space that focus on that and how those are coming along.
Yeah. So when you look at DI, so when you then start breaking climate, so environmental risks as a subtopic, investors look at it as well as diversity, equity, and inclusion, but also as safety risks. So one issues with environmental risk and climate is that you would find people in developing markets, underserved markets, needing solutions to help them. So, for example, ING, as a bank, European bank, has made significant investment, 30 trillion they intend to invest by the end of 2035 in solution to enable their building to be more sustainable, but also focusing on financial resilience, enabling people who do not know how to save money, how to be more wealthy, to actually learn to do that more effectively. So when fintech becomes actually a very important area for driving climate change behaviors. So startups doing great work in there, you will find UiPath and Stripe, for example, have climate risk-based impact programs in place. And so the other angle is a safety. So people who might be hurt when they are working on a platform, particularly when I mentioned oil and gas and energy type sectors, they have to pay more attention to people. The additional part is when you start looking at the value chain. Insurers today will start looking at climate risks into three buckets. Can I impact my operation? So from a D&I viewpoint, they are going to look at how diverse their workforce is to design the product and the services of tomorrow. So the climate risk prevention product of tomorrow. So having a diverse workforce able to do that. Supply chain management. So how do I work with my partner and make sure that my partners implement the right logic when I look at climate risk? And finally, the last one is product and service design. So the emerging risk comment I made earlier.
Thank you. Marcus, so you're in the parametric space. Can you briefly describe what parametric insurance is and why it's a perfect fit for some of the climate risk that we see and the mitigation thereof?
Yeah, there are two opportunities for creating an insurance. Indemnity insurance and on the other hand, parametric insurance. Indemnity insurance is more likely what we think, what John and Jane Doe think of an insurance, I guess. You pay your premium, and in case of claim, you call your insurer, and then it takes some time during the claim adjustment is done, and then you get the payback for or the check for the claim if it really has been a defined claim within the contract you closed before. The parametric insurance is also named as index insurance based, which means it has a bit a different approach. You more focus on the event itself, like as we talk with climate, we created, for example, an earthquake bond, where you can say, okay, if there's an earthquake which hits the area of XYZ, more than 6.5, the payout has to be done. And the claim adjustment itself must not be done by the insurer. It's done by an independent third party, which can be a weather station or something like this, which enables the insured to get the money much quicker on your banking account, because you do not need the the long-term claim adjustment anymore. And if we talk about catastrophe risks, of course, what you need most is money on your bank, and this in a quick way. And so parametric is here, I would say, more beneficial than a typical indemnity insurance because it takes less time. And it's just a if or if then constellation. If it's higher than 6.5, then the payout has to be done. And the reason maybe just to why we are focusing on that, we had a bit the blockchain hype a couple of years ago, and in our institute, we ask ourselves how will the digitization process or the digital transformation impact the insurance industry. And we came from the standpoint that a smart contract and a blockchain could assist here, because if you see it in a holistic way, the idea is that the insured closes a smart contract with the risk carrier, which might be an insurer or reinsurer, or what we also heard, a hedge fund. And then in case of claim, it's an independent third-party oracle who defines the claim. And so there's no human impact anymore needed, and the claim out, the payout can be done within hours. And as I mentioned, this is the great benefit of parametric, maybe linked with the blockchain technology of smart contract, because the money is within hours on your bank account and it does not take months anymore. And especially in catastrophe situations, you need the money quick to get back to business or rebuild your company or whatever you need, but you definitely need the money.
And if I could build on that a bit, Josh, Marcus, I think you mentioned sort of the difference between indemnity and parametric. And I think there's an interesting concept in the market around the two of those things, perhaps even working together. So for example, in an instance where you have an event like what happened in Texas in this past winter, the deep freeze, the polar vortex dropping into Texas, the indemnity losses stemming from frozen pipes and things like that, the industry is well suited to cover those through the typical adjustment process. A parametric may actually be able to add value in that instance, where if there is a parametric trigger that's driven on extreme cold temperatures in a place that's not used to extreme cold temperatures like Houston or Austin or Corpus Christi, the parametric can provide a payout to the policyholder quite quickly and can offset some of the costs that may be almost upfront costs. So, you know, if you're in an instance where it's been extremely cold and you had to leave your home because you have frozen pipes and need to find a hotel or something like that, reimbursing that cost, you know, can happen quite quickly. And the parametric can also help to reduce the loss to the policyholder that would be incurred under the deductible.
Thank you. Sabine, I'm going to drag you into this. Can you just highlight maybe for us what you're seeing in terms of interest in parametric products from a VC, private equity space, and whether or not that's where we're seeing money go right now?
I would say that VCs are looking at the bigger problem to start with. So they are looking at sizable markets to be solved. And so when I look at the investment and the startups getting funding, so for instance, recently we had a small event and we had a startup called, in farming, using actually parametric to actually provide insurance to farmers. And these startups, for example, raised funding recently from major insurers, from major VCs. And so there is a clear need to really understand the big problem where there is money to be made as well. And so when you look at climate and climate risk, the major bucket will be industry, such as oil and gas, agriculture, and mobility, which actually producing a lot of fossil fuel. And so the VC are going to look at those areas where there is massive, sizable market, where there is therefore money to be made. Healthcare being as well one area where they are looking at, for example, ventures in Africa, where one venture in particular is using a mechanism to get people to collect waste, to actually enable people with no insurance or health insurance to get that insurance. So they are looking actually at disruptive business models, which may entail looking at the way we build ecosystem and combine different solutions together, and also looking at what we call the circular economy, how we can reduce the fact that we waste a lot of things, and instead of wasting, we can repurpose and recycle things better to actually have better impact on the environment and on the planet.
Great, thank you. So Steve, can you get a little specific maybe with what type of product solutions you're seeing and how those solutions are delivering results?
Yeah, absolutely. And, to link to your earlier question too, I completely agree with Sabine. And I think the investment community, starting with the venture community, is pretty well suited to help initiate solutions in this space. A number of these solutions have been discussed for years. The challenge is that when you try to incubate these concepts within the walls of a large insurer or reinsurer, the level of the confidence on return, or the level of risk around how big of a market will this become, how long will it take to become a large market, those are questions that often the large reinsurers and insurers, those are gating questions. You ask those to begin with before you would even think about moving down a line like this. I think the venture community is well suited to see the longer road and to take some risks earlier on that the corporate sector might not be as willing to take. And I think an example of that is if we look at, let's think about winter weather. So if you are a facility manager for a shopping mall or a commercial office building, you basically are responsible for making sure that property is safe and passable in the wintertime. So let's take a place like New York City, right? So when there's a heavy snowfall in New York City, if you are managing a commercial office building, you need to make sure the sidewalk's clear. If you're running a shopping mall somewhere in a suburban area, the parking lot needs to be clear. Those expenses can vary dramatically from year to year. So in a place like New York or DC on the East Coast of the United States, you can have a winter that has multiple heavy snowfall events in a year. So blizzard after blizzard after blizzard. And we can just look at the last 5 years and point at one or two of those years that have happened within the last 5. In those cases, a facilities manager, the property manager, is probably exceeding their planned costs for snow removal. In the alternate years, perhaps the very next year, in a place like New York or DC, it might not snow at all. There may be very little snow in winter, in which case that particular business is coming in way under their budgeted expense for snowfall. These are the types of sort of day-to-day, month-to-month, season-to-season operating costs. And if you imagine, so that's from the perspective of a facilities manager or someone who's responsible for removing snow and ice from a facility. You can think about it from the opposite side of that coin, which is that there's a business who's primarily funded in the wintertime by going out. Their revenues are derived by clearing those properties. They're in the exact opposite seat, essentially. So where there is no snowfall in a year, that business is coming in way under their revenue projections. Where there is a lot of snowfall, they're probably having a windfall. So their revenues are very high. So the difference, the variability from year to year around these snowfall events has increased over the course of the last decade and is likely to continue to increase. So in an instance where a business is trying to understand, model, predict, live within a certain budgetary framework, we can use parametrics. We can use parametric insurance to put revenue protections in place or put cost controls in place so that in that very heavy snowfall winter, if you're the facilities manager, your cost might be 3 or 4 times what you have budgeted. And in that case, you can receive basically a protection payment so to offset those costs. In a year where there's no snow, if you're the landscaping company or the snowplow company, you can receive the parametric helps you make up for lost revenues.
Great. Thanks, Steve. Marcus, I'm going to go off script and just jump to you really quick on this. I'd like to get your take and your maybe some follow-up here. What are you seeing in the parametric space for coverage gaps when it comes to these major weather events, whether it's tornadoes, hurricanes, earthquakes? Are you seeing it tied mostly to indemnity or trying to be tied to indemnity products, or are you seeing it as standalone products? And what's sort of your opinion on which way to do it is better, if there is a right way to do it?
Yeah, first of all, I would say a right way to do it. There's definitely a need to offer it. But the question is always, or maybe we have to go a bit back into the insurance company themselves. It's based on the law of large numbers, the indemnity. And so from my perspective, if you have a landscape which is with a tornado or earthquake or whatever, the law of large numbers does normally not work out, because then every single house, for example, got hit by that event, and that makes it that hard to offer even insurance for such catastrophe events. Why I think parametric could help here much better than the indemnity approach is because, on the other hand, the policyholder needs the money fast, and the insurer would have the problem that so many policyholders got hit at the same time. So this is an asymmetry of interest at the end of the day. The parametric might be an opportunity for the insurers or the reinsurers to get also capital from the capital markets in, which is, from my perspective, needed if you want to cover catastrophe events which are already existing, but for sure become more and more in the next years and decades. From my perspective, the law of large number approach, where the insurance is based on, will not work out anymore. And this is why I say parametric is an opportunity to get capital market participants involved somehow, as we already know them as ILS funds or hedge funds, to spread the capacity. And then this is the first step from my perspective. And for them, it's easier to understand the parametric because they are familiar with index-based solutions. And the other benefit is for the policyholders themselves, because, as I mentioned, if we are involved in a catastrophe, we need the money quick on our bank account and not a claim adjustment which takes months. Because if I have the money for waiting months for my money, maybe I do not even need an insurance, because then I seem to be a wealthy guy, and then I have no need for an insurance to be closed. So here I see the great benefits of parametric, just to say, okay, we can spread the market or expand the market and maybe get some other institutions in, because I would say the catastrophe risks, like we have seen with pandemic, but especially the weather risks are the same level. This is a too big risk, which is not be possible or cannot be carried by the traditional insurance market alone.
Thanks, Marcus. So, Sabine, I'm going to leave you with the last question here. And I think it's relatively important because we're talking about climate risk at this event, this forum, and one of the key issues associated with fixing any problem is the money behind the problem and the money behind the solutions. So from your perspective, do you see these innovative products that focus on climate risk valuable to investors or to carriers, where they're going to get excited about this and start putting money behind some of these products that can really lead to a substantial mitigation of climate risk in the future?
So I guess my answer is yes. I'm taking here a European, lens, because since the past 18 months, what I've seen is initiatives I've been involved with, which have become the #1 initiative in major carrier insurers. And the problem we are looking at is not just the sustainability and climate risk problem. We are looking at it from what we call a transition risks problem, where we are looking at environmental risks, but also emission risks, safety risks, and diversity, equality, and inclusion as a sub-segment of the bigger risk. And when you start segmenting it like this, where we mean that transition risk, or the transition we are going into right now, is companies which are moving from one business model to the other, right? I'm moving from being a fossil fuel company to becoming a renewable energy company. That is driving a lot of change. The customer, the big corporates, who actually have to go through that transition, needs commercial insurance, needs specialty line insurance. And what is happening with those big companies is they are using a lot of tech, investing a lot of startups, acquiring a lot of startups to actually make themselves able to achieve a lot of the demands from governments. So as you see that shift from the big companies, what you find is the insurers also aligning their strategies accordingly and finding ways to design the new product and services that their big clients need to be able to fulfill the needs of the regulator or the government. So definitely a big need. And as a result, what we are seeing is companies cannot work in silos anymore. So we have been seeing or interviewing, big energy companies and oil and gas companies, construction companies, as well as enabling the insurer to better understand and, let's say, translate the problems that one needs to see solved. Partly that will be solved with data, partly will be solved with technology. Partly it will result in cybercrime and cyber risk. Partly it will result in a major additional type of transition risk. So what we are seeing is companies coming together as well, co-creating new solutions together to start solving the bigger problem of tomorrow. And what that means from an investor viewpoint, if you have a sizable market and a well-defined problem with a good business case, there will be funding associated with it.
All right. Well, thank you all for your time today. A half an hour goes by very quickly, and I hope that you took something from this, and the viewers will enjoy it as well. So thank you all, and thank you viewers for watching this.
I'm Alan Schnitzer, Chairman and CEO of Travelers. I'd like to thank Commissioner Mays for his leadership and for organizing this conference on climate change. We're fortunate to have someone like the Commissioner addressing one of the critical issues of our time. And at Travelers, we're committed to being part of the solution. Severe weather events over the last 2 decades have underscored the unpredictability of climate trends. And we should expect that changing climate conditions will continue to impact the frequency and severity of natural disasters. We understand that climate risk requires a different kind of focus, a different kind of response, and a different kind of resilience. Through our comprehensive approach to changing climate conditions, we want to prepare a better world for our children and future generations, while ensuring that our business is positioned for future success. As you would expect, as a core part of our business, we continually monitor, assess, and respond to the risks posed by changing climate conditions. We offer products and services that help our customers mitigate the associated impacts and that support the transition to a lower carbon economy. As one example, our dedicated global renewable energy practice is specifically designed to facilitate innovation and the growth of renewable energy businesses. As it relates to our own operations, we maintain a small carbon footprint. Our own facilities are all ENERGY STAR certified, and since 2011, we've reduced our greenhouse gas emissions by nearly 55%. Building on that progress, we recently announced our goal to become carbon neutral across our own facilities by 2030. We'll do this by reducing or offsetting an additional 50,000 metric tons of carbon dioxide, the equivalent of eliminating the impact of about 125 million vehicle miles over the next decade. And in 2019, we partnered with American Forests to plant a tree for each personal insurance customer who converts to paperless billing. We're well on our way to planting 3 million trees by June of next year. Additionally, we support organizations that promote stronger building standards so that homes in the most vulnerable areas are better able to withstand severe weather. We're proud of the work we're doing. We're a leader among domestic P&C companies in issuing an annual TCFD report. I invite you to learn more about what we're doing to address a changing climate on our sustainability website. We all have a responsibility to leave a better world for future generations, and this industry can drive a lot of good in that regard. Thank you for the opportunity to address such an important topic.
Hello, everyone. I'm David Altmeyer, President of the National Association of Insurance Commissioners and Commissioner of the Florida Office of Insurance Regulation. I'd like to thank Commissioner Mays and the organizers of this conference for inviting me to participate. This year, the NEIC is celebrating 150 years of supporting U.S. state insurance supervisors in their mission to protect consumers and ensure fair and healthy insurance markets. With an increasingly global marketplace and the growing importance of spreading risk globally, the NEIC and its members have a long-term interest in promoting sound insurance supervision and stable markets around the world. And a priority for the NEIC centers around climate risk and resilience. Along with my duties as NEIC president, I am proud to serve as commissioner of the Florida Office of Insurance Regulation, where we work consistently to cultivate a market in Florida in which insurance products are reliable, available, and affordable. Given the location and geography of the state of Florida, climate risk and resiliency plays a large role in considering how we mitigate the impact of natural catastrophes. And of course, our experience in Florida is not an isolated one. Insurance departments around the U.S. have always had to pivot to adapt to changes that affect us locally or globally. At the NEIC, we have used our shared experiences as a way to learn with and from one another, especially during the pandemic. And as we all know, climate priorities did not lessen in importance during the last 18 months. Rather, they continue to warrant our sustained attention. Climate and resiliency is a core priority for the NEIC with immense impacts. According to the National Centers for Environmental Information, the United States had $22 billion climate-related disasters in 2020, the most on record. The financial and societal impact of natural disasters around the globe has put a focus on climate risk-related work. Climate concerns stem from the two main pillars of insurance regulation: solvency risk from catastrophic losses and market issues regarding availability and affordability of coverage. In 2006, the NEIC established its first climate task force, and while the names of the task force have changed over the years, the commitment for addressing climate risk remains of critical importance. The NEIC's Climate and Resiliency Task Force under our executive committee was formed in July of 2020 and is comprised of over 30 chief insurance regulators with 7 co-chairs that represent the various geographic area of the United States. With this high level of coordination, the NEIC remains committed to creating innovative insurance tools and methodologies to help in predicting and responding to climate changes happening all around us. The task force is focused on 5 different work streams: solvency, technology, innovation, climate risk disclosures, and pre-disaster mitigation. We recognize that climate and resiliency discussions must encompass all areas of insurance regulation in order to truly impact the policies and protections our constituents require. Our solvency workstream is looking into enhancements to solvency tools to address climate risk more specifically. This work builds off the climate-related content that was added to the Financial Examination Handbook back in 2012. The workstream has already requested that the risk-based capital framework undergo a review to consider adding wildfire and other perils as necessary. They hope to have additional recommendations by the end of the year. The technology workstream is exploring the use and recent advancements of catastrophe modeling in insurance and working on ways to help states coordinate and share resources on this topic. They have requested an update to the Catastrophe Modeling Handbook, which was adopted by the NEIC in 2011. The Innovation Workstream is developing a repository of information on parametric products designed to fill coverage gaps caused by natural disasters. The Pre-Disaster Mitigation Workstream has developed a list of mitigation actions for all perils and is working with the industry as well as consumer groups to conduct consumer outreach on mitigation. Mitigation is a proven way to reduce property damage and provide better life safety. The Pre-Disaster Mitigation Workstream is focused on incentivizing mitigation and building resilience for the extreme weather events. The fifth workstream on climate risk disclosure has held discussions regarding the NEIC Climate Risk Disclosure Survey. The NEIC created a climate risk disclosure survey in 2010, which requires insurers to answer 8 questions about how they incorporate climate risks into their mitigation, risk management, and investment plans. Insurers are also asked to identify steps taken to engage key constituencies and policyholders on the topic of climate change. The Climate Risk Disclosure Workstream has spent the first half of this year understanding how the existing survey and TCFD align, as well as what disclosures from other groups are being used. These other groups include the Principles for Responsible Investments, CERES, CDP, formerly known as the Carbon Disclosure Project, as well as credit rating agencies with a focus on environmental, social, and governance rating factors, commonly referred to as ESG. The NEIC Climate Disclosure Workstream has collected comments regarding what frameworks to consider, what information should be collected, and whether the information should be publicly available, with hopes to develop recommendations for improving the survey by year-end 2021. Additionally, 9 states joined the survey in 2021, and the survey will capture approximately 78% of the market in 2021. Focusing on climate for a more resilient future requires a look at the changing technologies that are playing a growing role in our insurance marketplace. As companies turn to the use of big data and AI, the state insurance regulators and NEIC staff are working diligently to maintain a strong understanding of new technologies and predictive analytic tools. We recognize the importance of climate risk data in informing decision-making and disclosure, and that there is growing accessibility of climate risk models to help facilitate the understanding of climate risks and opportunities. Along these lines, our task force is also examining parametric insurance as an indemnity product, most often for small amounts of coverage. With parametric insurance, policies cover the probability of a predefined event happening and pays out according to predefined circumstances. Using data and analytics, often from sources like the NOAA and the National Hurricane Center, claims are paid out quickly based on a triggering event. This allows the insurer to skip the claims adjustment process. There are some regulatory concerns about how these products are designed and whether consumers fully understand how the coverage works. But with proper design and consumer education, we think these products can potentially be helpful in reducing the coverage gap that may exist in standard home or business owners' coverage due to policy exclusions, low limits, and high deductibles. With respect to my home state of Florida, last year we updated our catastrophe reporting form for 2020 and hosted a technical assistance webinar for all companies required to file as preparation for the expected rise in catastrophe claims data calls. We also continue to encourage consumers to make sure they are educated on the risks of flooding and to seek flood insurance coverage. Flooding is the United States' most common and costly natural disaster, and Florida leads the nation in the development of a private flood insurance market. Flood damages are not typically covered in a homeowner's insurance policy, and flood coverage must be purchased separately or as an endorsement to their current policy. By educating consumers on a continuous basis, we can help mitigate confusion and lapses in coverage when it is needed the most. I take great pride in the work the state of Florida does to stay proactive on climate-related matters. Along with the work of the Climate Risk and Resiliency Task Force, the NEIC is a member of the Sustainable Insurance Forum and the International Association of Insurance Supervisors, participating in international forums and contributing to resource materials regarding climate-related issues. In addition, the NEIC participates in discussions regarding risk and resilience at a federal level, including ongoing collaboration with the Federal Emergency Management Agency. While the NEIC and the states have been busy in this area, our federal counterparts are also spotlighting climate and resiliency in the financial services sector, including insurance. This past spring, an executive order on climate-related financial risks was issued, which, among other things, directs the U.S. Treasury Secretary to work with members of the Financial Stability Oversight Council to assess in a detailed and comprehensive manner the climate-related financial risks to the financial stability of the federal government and the U.S. financial system. The NEIC serves on the FSOC in a non-voting capacity and continues to monitor federal work and legislation in this area, coordinating and providing expertise where needed. I'm confident the NEIC will continue to take this work extremely seriously and remain leaders of the ongoing discussion on climate resiliency within the U.S. financial regulatory system. In all, it is clear to see that the NEIC and insurance regulators throughout the U.S. are focusing great efforts and energy on the area of climate and resiliency. I'd again like to thank Commissioner Mays for hosting this conference and allowing me to provide these remarks. Being engaged helps us to enhance the effectiveness of insurance regulation, to protect consumers and policyholders, and to promote stable and competitive markets both here in the U.S. and abroad. By sharing our experience and expertise, we can help inform best practices and standards. Thank you, and enjoy the rest of the conference.
People in Connecticut don't need to read research papers to understand the impact of climate change. The ferocious storms that ripped through the state this summer, the amount of rainfall that landed in people's basements, that washed out roads, is evidence that climate change is here, it's real, it's a danger to homeowners, it's a danger to policymakers, but it is also a peril for insurers. And so I'm glad that we are really having a conversation in Connecticut about how the insurance industry, so vital to Connecticut, can play a leading role in changing state and federal policy to attack climate change. Because people are going to expect more of their insurers. They are going to demand more in reimbursement for damage. And so one of the ways to mitigate that is for us all to work together to do our part to pass big climate change legislation. Now, the state can do its part, but really this has to be done at a federal level. And so I'm asking all of you, those of you who work in the insurance industry, regulators as well, help us pass meaningful climate legislation this year in Congress. I'll be happy to work with you on the details to get you to understand more about what we're considering. Renewable energy standards, investments in electric vehicles, more money for mass transit. So be in touch with my office if you want to sort of move from being an advocate to a champion, because we need your help. I think it's in our mutual interest.
Hello, everyone. Welcome to the Connecticut Conference on Climate Change and Insurance panel discussion on social justice and climate change. I am Matt Lesser, the co-chair of Connecticut's legislature's Insurance and Real Estate Committee, and I'd like to begin by introducing some of the great panelists we have here today. Joining us today is California's Insurance Commissioner, Ricardo Lara. Dr. Laura Bosey is director of the Yale Center on Climate Change and Health. Sonia Larkin-Thorne, formerly of the Hartford, has had a lengthy career working with the National Association of Insurance Commissioners and earlier on with the California General Assembly. Samantha Danowski is the director of the Connecticut chapter of the Sierra Club. And Michael McCord is the founder, president, and currently managing director of Microinsurance Center at Milliman. Welcome. We are happy to have you here all today. And I'd like to start out with Commissioner Lara and highlight his efforts to address climate change. Commissioner Ricardo Lara has a long record as one of California's most effective environmental champions, passing laws that promote innovation and investment in clean air, embracing equity, protecting waters from oil drilling, and keeping California at the forefront of combating global climate change. He wrote the nation's first climate insurance law to protect Californians from climate-linked environmental disasters like wildfires, extreme heat waves, and sea level rise, and is co-chair of the Climate Risk and Resilience Executive Committee Task Force at the National Association of Insurance Commissioners. Commissioner Lara received the 2017 UN Climate and Clean Air Award with California Governor Jerry Brown for their groundbreaking work to create California's short-lived climate pollutant strategy.
Thank you for the opportunity to be with you and discuss this important issue, and on this with this panel to share my thoughts on how climate change and social justice intersect. Climate policy and social justice really tend to collide because many of the most vulnerable communities around the country, specifically here in California, are projected to face the most destructive consequences of climate risk impacts. If jurisdictions at all levels, federal, state, and local, do not make significant progress on risk management, climate change impacts will really be exacerbated and really continue to demonstrate the tremendous inequality amongst our communities of color. Climate change is already intensifying extreme heat waves, and we have seen the tragic consequences that affect communities of color and low-income communities throughout the world, and of course in our home state of California. I'll give you an example. During the summer heat waves in France in 2019, elderly individuals made up more than half of the deaths. And in Quebec in 2018, heat waves, deaths related to heat waves were disproportionately towards isolated older individuals. Flooding has a disproportionate impact on low-income communities and communities of color, as we've seen just recently. And for climate impacts where evacuation is essential, are LGBTQ plus individuals, socially isolated individuals, and those with disabilities are among the folks that, face additional barriers to safe evacuation and access to evacuation sites, or even receiving early warning communication. So, the climate projections for California are that rain events will intensify, high severity of wildfires will become more common, and heat waves will be hotter and longer. When these events occur, insurance is a means of financial resilience. But again, the question is, who gets left behind? We should be focused on how we, as public policymakers, can close a protection gap so that all communities can prepare and recover when a disaster strikes. Focusing, I believe, on our most vulnerable communities, we need to strengthen each step in our risk management. Ensure that our risk assessment identify where communities are more vulnerable, communicate risk effectively to low-income communities and communities of color. We have to reduce risk through mitigation, preparation, and investments in natural infrastructure. And, I believe improving the capacity for insurance to support equitable recoveries by closing that protection gap. With greater investments in risk and improved tools for financial resilience, communities are likely to enter a damaging kind of feedback loop where escalating risk lead to increased losses, then financial consequences, fewer insurance options, and really diminished capacity for future resilience. So as we prepare for future risks that include more severe heat waves, storms, and wildfires, as well as sea level rise for those of us on the coast, our working group really needs to put a focus on not just one peril, but all of these climate impacts and how they affect communities of color and our low-income communities. we cannot ignore the reality that we see every day. Climate change is creating and exacerbating inequities in our society. The protection gap is growing. And really, we cannot accept a future where climate change increases the gap between the wealthiest and the rest of us. I believe insurance has an important role to play in keeping communities safe in the face of climate change. And as insurance commissioners and regulators, we have an important leadership role in making these goals a reality for communities in all of our jurisdictions throughout our entire state. Thank you, and again, it's great to be here with all of you.
Thank you, Commissioner. Next, I'm happy to welcome Laura Boese. Dr. Boese is Director of Programs for the Yale Center on Climate Change and Health, where she leads the center's policy and public health practice work in Connecticut, teaches the clinic in climate justice law and public health, and is leading development of the YCCH Policy Impact Unit. Previously, Dr. Boese led the Rhode Island Department of Health's climate change program, and in that role, she worked to promote policy change, increase public awareness, and support community resilience building strategies that collectively help both mitigate climate change's negative health impacts and promote health equity. Laura was appointed as a member to the State of Rhode Island's Executive Climate Change Coordinating Council, that's the EC4 Advisory Board, and the Agricultural Lands Preservation Commission. Dr. Boese, please go ahead with some opening remarks.
Thanks so much. And thank you for inviting me to speak today. I'm really pleased, especially to speak on this important topic. So my introductory remarks, I want to relate to the panel theme and emphasize that while climate change affects everyone, it doesn't affect everyone equally. Climate change is sometimes called a risk amplifier, meaning that many existing risks to health based on environmental, economic, demographic, social factors are intensified by climate impacts. To say that a little bit more pointedly, it's also that deep and long-standing inequities in our country's systems and policies are now made worse by climate change, so that in particular, communities of color and low-income communities are likely to be hit first and worst, and to be least able to recover from the impacts to health and well-being from climate change. For instance, studies have found a relationship between past redlining practices and current localized temperature disparities. Redlining, as you may know, was a practice in the 20th century to reinforce racial segregation in America's cities and to limit the ability of African American families to accumulate intergenerational wealth. Through that process, local and federal officials designated certain areas as risky investments for mortgage companies because the residents were African Americans. Fast forward to today, and there are studies that show that those areas that were redlined are hotter than the surrounding parts of the city. And indeed, many of those residents are still people of color. They also are often lower income, meaning that their housing quality is lower. They have less access to air conditioning, and the warmer temperatures are due to fewer trees, more pavement, and so they are more sensitive to these impacts and less able to adapt. As another example, people with chronic diseases are more likely to become sick or die during an extreme weather event. We see that when power outages happen during a storm that are powering electric medical devices, or in other instances, wildfire smoke can trigger asthma attacks among people with asthma. People with disabilities are at greater danger during an extreme event. They might have difficulty evacuating. The evacuation shelters might not meet their needs. And people with disabilities, as well as older adults, have been found to face particular challenges in obtaining federal disaster assistance after the disaster. And all of these risks are further amplified when a person has few financial or social resources in order to adapt. These are a few examples. Unfortunately, there are many more, and they occur across the country, including here in my state in Connecticut. And so what I want to emphasize is that we need to treat climate change as a public health crisis and not just as an environmental crisis. And we need to understand it in the context, as we have come to understand during COVID, that this is an issue that magnifies existing inequities. And we need to incorporate that into our policymaking around climate change to address those existing inequities and repair them. I'll stop there with my initial remarks and look forward to the questions. Thank you.
Thank you so much, Dr. Bosey. Next, I'm happy to introduce Sonia Larkin-Thorne. Sonia recently completed a very long and prestigious career with the Hartford, and she is still active in insurance issues today, having recently retired as Vice President of Government Affairs for the Hartford with over 35 years of experience. She managed their regulatory and legislative activities in 14 states, provided counsel on underwriting practices, market conduct examinations, urban issues, consumer complaints, use of insurance credit score guarantee funds, solvency issues, natural disasters, and financial services legislation. A lot of different things. Sonia represented the Hartford at the National Association of Insurance Commissioners and served as a member of the Property Casualty Insurance Guarantee Fund boards in Arizona, the District of Columbia, Maine, and right here in Connecticut. Prior to joining the Hartford, she served as senior consultant on insurance to former California Speaker Willie Brown. Sonia, please go ahead.
Thank you, and thank you for inviting me to participate in this environmental concern issue today. The United Nations recently declared a code red for humanity when they talk about climate change and the problems that human-induced climate issues are, how they are impacting people, and the many weather events that we are seeing in extreme nature today. There are so many consumer concerns as a result of this, because consumers don't understand that anywhere it rains, it can flood. All 50 states in this country are at risk for flood. There is no such thing as a safe spot from flooding. And yet people don't understand that floods are the most common and deadliest natural disasters in the U.S. But 9 out of 10 homes are not insured for flood in the U.S. Hurricanes are getting stronger in terms of their winds. We are experiencing torrential and heavy rains. Tropical Storm Henri, Superstorm Sandy, Hurricane Ida were once only thought of as possibly 1,000-year events. But what we're seeing now with rising sea levels, increased coastal flooding, extreme weather events, these are all becoming more common. And our cities with aging infrastructures are not equipped to handle what we are seeing as a result of these events. The majority of our consumers have no knowledge of and little understanding of climate change, but most importantly, they do not understand how it will impact them and their lives. Consumers don't understand the risk of flooding and water damage, and how that small creek behind their home suddenly becomes a raging river with 4 inches of rain over a short period of time. Ida and the remnants dropped massive amounts of rain in Connecticut. We experienced in this state the loss of life, vehicles stranded or submerged by floodwaters, roads washed out, power outages, water rescues from homes in Plainville, Connecticut. Bottom line, our infrastructure couldn't handle the increased amounts of rain, and many homeowners and renters were without a flood insurance, and they lost tremendous amounts of personal property. We need to increase our consumer outreach and education regarding climate change and the impact it can and does have on us. In Connecticut, we know that only 35,000 flood policies are currently in place out of approximately 1.5 million housing units. There is a lot more that we could and should be doing to help educate our consumers through public outreach. There's a lot more that we should be doing to provide our consumers with the needed education and protection that they need until our infrastructure is brought up to date and can protect them from the loss of flood in the state of Connecticut. I'm not going to be long in my remarks because I think you all get the concerns that I personally have and that we should all have regarding the issue of climate change and the immediate impact it is having on consumers in the state of Connecticut.
Thank you so much, Sonia, for sharing your perspective. Next, I'd like to introduce Samantha Dynowski. Samantha is the director of the Connecticut chapter of the Sierra Club, the most enduring grassroots environmental organization in the United States. Sam is the state director, but also works alongside numerous dedicated volunteers to fight climate change, reduce pollution, protect wildlife, and eliminate threats to air, water, and land. Having a considerable career in advocacy, Sam was Director of Advocacy and Outreach at the Connecticut Early Childhood Alliance prior to her joining Sierra Club Connecticut.
Thank you, Senator Lesser, for the introduction, and to the Department of Insurance for the opportunity to participate in this panel. As Senator Lesser said, Sierra Club is the nation's oldest and largest grassroots environmental organization. We champion solutions to the climate crisis and fight for a just, equitable, and sustainable world for all. We have over 60 chapters, including our chapter here in Connecticut. And I am here, and I think all of us on the panel are here because we are concerned about climate change. We're concerned about the impact on vulnerable communities, and we're concerned about the role of the insurance industry on these issues. My focus will be on the outsized role that insurance plays in driving climate change and why the insurance industry must address it. There are two ways in which insurers are enabling the climate crisis, and that is through their investments and through their underwriting. On the investment side, insurers and other financial institutions are some of the largest investors in the fossil fuel industry. For example, according to the most recent data collected by the California Department of Insurance, Travelers, which has its largest office in Hartford, Connecticut, had $3.5 billion invested in fossil fuels, including oil companies Chevron and Exxon, and pipeline companies Halliburton and Kinder Morgan. The Hartford, headquartered in Hartford, Connecticut, had over $3.2 billion invested in fossil fuel and utility companies, including Chevron and Exxon, the builder of the Dakota Access Pipeline, and fracking giant Chesapeake Energy. On the underwriting side, property and casualty insurers provide insurance for fossil fuel companies and for fossil fuel projects. And as we are all aware, nothing can get done without insurance. So the underwriting of fossil fuel companies and projects by property casualty insurers is another way the industry is propping up climate-destroying fossil fuels. Unlike investments, underwriting is more challenging to quantify as most policies are not made public. Those at particular risk for exposure to the impacts of climate change are Black and Brown communities. These same communities are also disproportionately impacted by the extraction, production, and transportation of fossil fuels. So in short, the investment and underwriting of fossil fuels by the insurance industry is holding up the environmental injustice of turning vulnerable communities into sacrifice zones. So that is the problem. What needs to be done? Sierra Club, Connecticut, and other organizations across the nation are part of a campaign called Insure Our Future, which is urging insurers to take steps to address this. On the underwriting side, to immediately cease insuring new and expanded coal, oil, and gas projects. And to immediately cease insuring coal companies unless those companies have a coal exit plan that meets specific exit criteria. And to phase out insurance for oil and gas companies that are not in line with a pathway that ensures global temperature increase stays below 1.5 degrees centigrade. On their investments, insurance companies should divest all assets from coal, oil, and gas companies that are not aligned with this 1.5 degree pathway. And they can bring their stewardship activities like their membership in trade organizations, and their public positions as a shareholder in line with the 1.5 degree pathway. And finally, They must ensure that their underwriting clients fully respect and observe all human rights, including the right to free, prior, and informed consent as articulated in the UN Declaration on the Rights of Indigenous Peoples. So I'm sure it's not a surprise to hear Sierra Club holds this position, but we're not the only ones sounding the call on this. In June, the UN Secretary General made a plea specifically to the insurance sector to stop underwriting and investing in fossil fuels, especially coal. And 2 reports came out this year that addressed this topic. The first was from the International Energy Agency, which concluded that no new fossil fuel projects can be built in order to keep temperature increase under 1.5 degrees Celsius, and the other from the French bank Société Générale that says reducing exposure to oil and gas should be the next environmental objective for insurers. So in sum, we all know we have a role to play in the climate crisis, and the insurance industry is no different. They must take action to stop investing in and underwriting fossil fuels. And I will conclude by thanking you again for the opportunity to be part of this conversation and look forward to the questions.
Thank you, Sam. And our final panelist to welcome here today is Michael McCord. Michael McCord is one of the world's leading experts in developing and managing microinsurance products. His decades of experience include working as controller of a U.S. commercial bank, chief executive officer of a microfinance institution in Uganda, and regional director for microfinance programs in Africa with Finca International. Michael founded the Microinsurance Center, an internationally recognized consulting firm and microinsurance thought leader, committed to providing 3 billion low-income people across the world with access to valuable microinsurance products. A few years ago, the Microinsurance Center joined Milliman, a global consulting firm with deep insurance expertise and a shared vision for protecting people in emerging markets from sliding back into poverty. Michael, thanks.
Senator Lesser, thank you so much, and thank you to the other panelists. This has been a real honor to be with all of you and to be invited for this event. Let me just start by saying that microinsurance is insurance that's specifically designed for low-income people. Not just generic insurance that we try to sell to low-income people, but specifically designed for them. And I'm particularly interested in this panel because low-income people, as we've heard already, are tremendously impacted by climate change issues. And I see this across the globe, including just here. We've seen it on the news recently, right, with Henry and Ida and Nicholas. Low-income people are getting the worst risk structures, and they're having to survive through these issues, including the fires in California and elsewhere, the floodings, the heat waves, right? As was mentioned before, with no air conditioning, no ability really to protect themselves around this. And for me, this is a tragedy. How can we let low-income people suffer through this without doing anything to work with them to generate insurance products that fit their needs? And so that's what I've been doing for the last 25 years, is trying to develop insurance products so that low-income people can get the kind of insurance products, risk management that they need. And because they're disproportionately impacted by climate change, my work has been much more busy and active. We have issues all across the globe where I go. I stood with someone in Tajikistan just before the COVID outbreak, and he told me about how he can't grow his crops anymore because the crop cycles are tightening up and his crops need more time to grow. We work in the Philippines where they've had super typhoon Haiyan and others, and it's the low-income people that get affected there. They're buying places that are cheapest, that have the most risk. They're in the most precarious positions. And what we do really is to help them to try to develop risk management tools for that. And we work with insurers across the globe to do that, including reinsurers. We work with Munich Re and Swiss Re, AXA Re, who are all very interested in helping these low-income markets get some level of social justice in terms of risk management. I think I do want to say that in terms of microinsurance being specifically developed for low-income people, I think if we think about the continuum of insurance products, right? Products from the very high market, the multinationals, the large Walmarts and others. They get a different product than I get. It's sold in a different way, it's packaged in a different way, it's serviced in a different way. All we're doing with microinsurance is trying to develop products that can help people at the low-income market in a way that fits their needs. And so we spend a lot of time going out and understanding, what are the needs you have? How do you manage them? How can we address these with insurance? And there's lots of things that we can do with insurance. Everything from straight insurance products and coverage to using these to help people get through the changes, the adaptation that's needed, and helping people to also address the kind of secondary issues, but the health issues that Laura was talking about, right? The health issues that come with this, how do they deal with those? And so we're trying to put together products and make things work so that low-income people can get better risk management for their particular needs. And so really a lot of what we've been trying to work on over the last couple of years is how do we take 25 years worth of experience internationally and around the globe in developing countries, how do we take those lessons and bring them back to the US and re-engineer them such that we can take advantage of the lessons and help low-income people in these communities, in these states, in the US to actually have better risk management. And so I'll leave it there and I'll say more at the questions. Thank you very much.
Thank you so much, Michael. And now that we've heard from all of the presenters here today, I'd love to get into some Q&A. So building on Michael's comments about folks who are really on the front lines and the inequities built into our system, I guess my first question is for Commissioner Lara. As Commissioner, you see firsthand the aftermath of climate-intensified disasters. We've seen them all over the news in California. Where do you see the opportunities through insurance to help address social inequities in recovery?
Thank you. That's an important question that I have been focusing on. When severe climate events occur, who are the folks that are left behind? Climate change is intensifying natural catastrophes. At the same time, we are seeing a widening in the protection gap. This is the gap between the losses that are insured and the losses that are underinsured or not insured at all. A wider protection gap leaves most vulnerable communities exposed and can really, again, exacerbate inequity. Heat waves, flooding, and wildfires hit our most vulnerable communities the hardest. We've seen that throughout our entire country. Low-income communities and communities of color experience higher rates of heat-related exposure and deaths and greater damages from flooding. The best long-term resilience strategy is a dramatic reduction in greenhouse gas emissions. We all know that, including super pollutants like HFCs and methane. We can address this by focusing on, I think, really a few key points. First, we need to communicate that risk effectively so that communities know the risk and can take actions to mitigate that risk. Secondly, where and how we build matters. These are opportunities for us to build smarter, to mitigate before an extreme event occurs, and look at the type of materials that we're using to build. And third, we need to close that protection gap. And I think to do this, we need to invest in risk reduction. We need to bring down the overall risk to communities. For example, investments in natural infrastructure like wetlands, urban forest, and ecological forest strategies can reduce damages to the health and structures and promote social equity by protecting vulnerable communities. Innovative insurance products and nature-based solutions can promote affordable insurance, and that will enable communities to get stronger recovery. I feel that these are kind of essential ways that we can essential things that we can do to reduce that protection gap, and also look at how we use insurance as a tool to also leverage funding so that we can work on the mitigation piece before a disaster strikes, which often is costly and often some of the local jurisdictions cannot do because it's just costly and it's difficult to do. So these are things that we all can work together on, and we feel that by leveraging insurance as a way to not only promote these products, but where we build, how we build, and how do we mitigate, we can create a safer community for every Californian or everyone in the country, regardless of their social and income economic level.
Next is a question for Dr. Laura Boese. What can insurance companies do to reduce risk to health from climate change?
Thanks. So I think it's important to remember that we need to work on two fronts. So one is that climate change is here. As we've talked about, we are experiencing its impacts now, and the impacts will worsen. So we need to be better prepared for those impacts. And insurance companies, particularly health insurance companies, can play a role, especially around prevention. So I think Kaiser Permanente has done some really great work on other factors of social determinants of health with that kind of prevention. Working on supporting healthy eating and farmers markets to address diabetes from occurring later in life. So that kind of thing applied to the health impacts of climate change is important. But then second, we need to stop climate change from getting, we need to stave off the worst impacts of climate change. And as Sam mentioned, we have a global goal of limiting warming to 1.5 degrees Celsius. And we need insurance companies to be fully at the table and leaders in that. Because insurance companies will be also facing those impacts of the costs of climate change, and indeed are helping support climate change in their investments of their assets, and in insuring those companies. And so we need the insurance companies to step up and really take action on climate mitigation.
Great. Thank you so much for that. And in any of these, if anybody else wants to jump in at any time, please go right ahead. But Sonia Larkin-Thorne, I have a question for you. Can you name one major impact you see climate change having on consumers today?
Well, actually, I can do more than one, but let's focus in Connecticut on the issue of the increased impact of these rain events that we are seeing, and the need for consumers to understand how to properly protect themselves. They need flood policies, which many don't understand that their homeowner's insurance does not cover. We saw that recently after the rain event of a few weeks ago from Ida, when we had individuals being interviewed on the news program saying, well, my homeowners didn't cover flood because I wasn't in a flood zone, not knowing that your homeowners doesn't cover flood whether you're in a flood zone or not, that consumers need to purchase a separate flood policy, whether from the NFIP or from a private flood policy from an insurer who sells private flood policies. But more importantly, there is a strong need, especially for consumers in urban environments, to understand the risk of flood, understand why they need to protect themselves. And the Connecticut legislature needs to engage in this issue by properly funding consumer education and outreach with the Department of Insurance. It's not enough for our Department of Insurance to have posted on their website all the information about flood insurance and where to go to buy it. You need to approach it from a non-traditional perspective. Everybody doesn't go, especially our seniors, into the department's website to look for information. we need to reach out to these consumers in different ways, whether it be through a kiosk set up at their church, or a kiosk set up at their local library, or in the grocery store. We need to talk also about the issue of affordability of this additional expense for a flood policy, and how we as a state are going to assist these consumers in being able to purchase that flood policy, whether it be through a method like Mike talks about, through micro insurance, or through some method to purchase a group policy. We've seen that discussion through cities saying that maybe we should purchase a group policy for our cities that covers our consumers or our residents. But there needs to be a non-traditional approach to reach out to consumers in our urban environments who are most at risk because of the lack of a modern infrastructure to provide them with the type of protection they need. And that education is so critical for consumers to be able to protect themselves and to also address risk mitigation. Those are just a few of the issues or areas that we should address in the very near future if we're going to assist consumers in the area of climate change and understanding its impact on them.
Thank you so much, Sonia. And I can just speak personally as a state senator. I can tell you that after recent rain events, I think a lot more of my constituents are aware that they are in flood zones and what that means. So that, those are really great points. Turning to Samantha Dynowski, I was really interested by your opening remarks. But besides mitigating climate change, do you see other reasons that would compel insurers to divest from fossil fuels or end underwriting for fossil fuel policies? What would you see as a potential advantage for them?
Yeah, sure. Great question. Others are talking about the costs of to human health. And so there are costs being driven up and people's lives being impacted. The disproportionate impact on vulnerable communities is a huge equity concern. And so, those are two huge areas where insurers have a responsibility to step up. But there are also other reasons that getting out of fossil fuels would be good for insurance companies and would be good for their shareholders. As an investment, fossil fuels has not performed well relative to the overall S&P index over a 10-year period. Fossil fuels have performed very badly. And with a push towards renewables, the future does not look good. So as an investment, it's not a very good investment. With extreme weather comes impacts on the insurance industry. And so it's also driving losses to insurance companies, climate changes. And so divesting and ending underwriting for fossil fuel projects can help mitigate that. One example is the Travelers recorded after-tax losses of $1.3 billion in 2018 from natural catastrophes. That included $314 million in losses from the Camp Fire in Northern California. So the impact on the industry itself is large and growing. And then lastly, their reputation is at risk by continuing to support fossil fuels. It's bad for their corporate reputation, and it particularly makes it harder to recruit young people to the workforce. With a workforce that is older and retiring and trying to replace them, young people are keenly aware of climate change and the impact it's going to have on their future. And that concern is driving their choices as to who they want to work for. And they want to work for companies that are doing the right thing to protect their future.
Great. Thank you so much, Sam, for that. Now, lastly, turning to Michael McCord, what are the pieces that really have to align to make microinsurance successful?
Thank you, Senator. Thank you for the question. What we've found over all these years trying to get insurance to low-income people, including around climate change issues, there are really four components that we have to address. This can't happen if we just hit one piece. We have to create an environment where this can work. And so there are four pieces. The first is the market, of course. We have to get people to start understanding better what these needs are. We have to have products that match them better, and we have to do that by understanding them. And so we talk to people and develop products and develop services and mitigation strategies with them. And I think that's really important, understanding the market. We also need insurers who are interested in coming into this market, who are willing and interested and flexible enough to try something. Now, I can't just go and say that this is a CSR play, a corporate social responsibility play. There has to be a business case at the end. We have to be able to balance the needs of those clients with a business case for those insurers. And so we work really hard to do that because we know it's not going to last. And these kinds of products, and especially climate change products, they need to be there a long time. We have to use them and use insurance to make big and important changes. We talked about, or Sonia talked about, the need for helping people to understand these issues better. And so we use distributors, we use information sharers, if you will, all over, because people aren't going to listen to somebody like me, low-income people. They're going to listen to their friends, their peers, their church, the beauty shop that they go to on the corner. They're going to listen to those people. How do we leverage those pieces so that we can get information and then products and service through some of those entities? One of the largest microinsurance groups in South Africa is the Zion Christian Church. So we need to start using some of these entities and leveraging those. And the fourth, so it's insurers, distribution, the market itself, and the fourth is the enabling environment. It's the insurance regulations. And one of the problems that has consistently hindered microinsurance in the US in particular have been regulations. There is a need to think about how do we make regulations better for insurers to do this business, better for us to be able to do this business. Just for example, churches can't sell insurance in the US. If we're talking about low-income people, why not? If we've got simple products, why not? So we need to be flexible in terms of regulations and think through some of these things that we really need, some of those things that we don't need. Also policies. A lot of the countries that we work in, they have financial inclusion policies. So the recognition that low-income people have to be able to get insurance. How do we do that as a country? How do we create a policy and a structure and a roadmap to make that happen? And I think that's really important. And then there's, of course, technology and other support structures that are out there. But these four pieces, if we can get them to align, we can get success in this market. If any of those pieces are not there, then we have great difficulty. So again, that's insurance, distribution, market, enabling environment. Thank you.
Great. Thank you. My next questions are for Commissioner Lara. Commissioner, one question of personal interest to me. How can state legislatures and insurance departments like California's and Connecticut's that are really interested in this issue best work together to tackle the issue of climate change? And is that best done bilaterally or through existing organizations like the NAIC? And also, Commissioner Lara, as climate risks accelerate, how can the insurance sector be a force for resilient solutions to protect communities?
Again, we know communities that have insurance coverage have generally recovered faster and stronger than those without. And reducing the risks, reducing those risks makes insurance more affordable. So insurance policies should provide incentives to mitigate homes and communities. And we need new types of policies for extreme heat, which is something that I've been focused on in my work at the National Association Task Force and in our working on our climate risks in California. Better risk understanding, widespread risk communication, investments in community risk reduction, and closing that protection gap. I think that's the pathway for reducing climate impacts and promoting equity in our communities. And so again, it's about using innovative products, making sure that all communities have access to insurance policies to protect from that risk, and working together as a community to lower that risk overall so that we keep insurance writing in these communities. That is how we feel we can really get out of this conundrum we find ourselves in and this constant battle against climate change.
Thank you so much, Commissioner. Sonia, what can and should we be doing to assist Connecticut consumers right now?
Well, there's a lot that we can and should be doing, but I think the first, and this may be a repeat of what I said earlier, is we have to fund the extraordinary expense that the Department of Insurance needs to do the type of consumer outreach and education. We have to bring a partnership together with the department, with the agents associations, and the various other consumer organizations within the state to assist in this outreach that needs to be done. I don't believe that we should say to the insurance companies, it's your responsibility, because it's our responsibility as a state to educate our residents on what they need to do to protect themselves. And as I said earlier, we have to go to non-traditional methods to reach our consumers, to educate them about what they need to do and how important it is. Connecticut has a large number of local libraries, and I'm amazed at how the libraries have played a tremendous part in keeping communities together during the COVID shutdowns with their individual Zoom events that they've had in educating consumers on everything from archaeology to Mediterranean diets. We should be reaching out to them, reaching out to our schools. That insurance should be an integral part of educating our high schoolers about the importance of insurance and protecting themselves. It's not just auto insurance, but it's also homeowners insurance. So I think non-traditional methods are churches. While I may not, Michael, agree that we should allow churches to sell insurance, I do believe that they are an integral part of what we can do to reach our seniors in this state who are most at risk for tremendous losses if, in fact, we have a rain event that results in floods. I just think setting up kiosks and going into fairs that we are now having in Connecticut, just every place where we know a consumer is going to be. We can use members of our legislature when they have their community outreach programs and going into the communities or their Zoom events to talk. We can use town meetings. There are so many opportunities to reach our consumers regarding the need to improve their insurance coverages, especially when it comes to catastrophic losses, that any of us could sit down and come up with a page of opportunities that could be used to reach our consumers. But I think most importantly is to fund our insurance department properly so they can do the type of education and outreach that's needed to adequately inform consumers of the risk to climate change and the flooding events that we know are going to occur and have occurred in our state recently.
Thank you so much, Sonia. And Samantha, are there developments that you can report on that you've seen recently in the insurance industry?
Yeah, like I said, there's a lot of organizations calling for change, and we're certainly seeing some movement. International insurers are really leading the way. There's a critical mass of major global insurers, at least 26 so far, who have limited or ended their support for coal. And some are beginning to restrict underwriting for oil and gas. And as a result, coal companies are facing rate increases, and controversial projects are struggling to secure coverage. But by and large, the U.S. insurance industry continues to provide a lifeline to coal, oil, and gas. There are some that have adopted policies. So 4 North American insurers have committed to limiting coal underwriting, and those are Chubb, Access Capital, Liberty Mutual, and the Hartford. These policies are weaker than their leading European companies, but they're a start, and we hope those companies will continue to adopt stronger policies. Two North American insurers, the Hartford and Access Capital, have committed to limit insurance for tar sands. But not one U.S. insurer has yet to adopt a policy on oil and gas expansion. So we're looking to the global insurers who are leading the way and asking our insurers here in the U.S. to join in that. Another development, I want to recognize that decision makers here in Connecticut are really showing leadership on these issues. Our Connecticut Department of Insurance has been raising climate change as an issue for years, and having this panel is really an indication of their commitment to continuing the conversation on these issues. And our legislature and our insurance committee, with you as its co-chair, Senator Lesser, has been on the leading edge. And so while we have a long way to go, and certainly the issue is a concerning and serious one, I'm very happy to be in a state and to see the leadership that's being demonstrated to address this issue.
Thank you so much for that, Samantha, and appreciate the shout outs. And I know this is also an important issue for Commissioner Mace as well. Turning to Michael McCord, you've spoken a lot about microinsurance abroad. Is there really a role for microinsurance in the U.S., and can it be a tool that could help us address the impacts of climate change?
Yeah, Senator Lesser, there definitely is a role for microinsurance and the lessons that we've learned overseas here. People argue with me that we have cheap products. We have cheap insurance covers. But microinsurance isn't just cheap covers. As Sonia was pointing out, right, we need to help people to understand these things properly. That requires a different means of conveyance of the information. It's much different. It's that environment that we have to be thinking about. And so I think there's a really important role here, because we do have a very substantial number of really low-income people. And they have very little protection. They put themselves at risk because of their financial conditions. And this is even a generational problem that we have. If they lose their home, they struggle to regain what they need. Children have lesser opportunities, fewer opportunities. And so this is a long-term issue, and insurance can help do that. But let me be clear that I'm not saying that insurance is the answer. Insurance is not the answer to climate change. It's a piece of the answer, and we have to think about it more clearly. This isn't just, provide cover for homes, provide cover for these other issues. It's how do we, in the long run, think about these risk matters and help to improve them. And so adaptation is a critical issue in climate change. How do we help people to move from one area to another? How do we help them over the reluctance of change? And insurance can help us do that. In Kenya, there are products where agriculture farmers are planting different seeds that they didn't want to plant, but they were convinced to do so because they had the background in the insurance. And these are things that I think we can think about in terms of people living on the coast and such. I think indirect health and mortality consequences, these can certainly be addressed better by insurers. And housing issues, of course. We have big problems with housing in Connecticut and throughout the U.S. And these houses are often not of the quality that's important. And insurers have an important role in terms of setting standards. Right? We often forget that role, but they have a role in setting standards. But I think they need to come together with others and try to think about how can we create the knowledge, the information, and how do we create different risk management tools that help low-income people to weather these storms and to get through climate change, to work through the issues of climate change.
Well, thank you so much, Michael, and thank you to all the panelists. We are out of time, but this has been just a remarkable conversation and a remarkably accomplished group of folks. And so I'm sure we could have gotten another hour, but thank you to all the panelists for sharing so much in the time that we had. So I hope everyone has a wonderful rest of their day. Thanks. Take care.
Thank you.
I'm Andy Mays, Connecticut's Insurance Department Commissioner, and I hope you found attending the C4I, this first Connecticut conference on climate change and insurance, as rewarding as I did. I'd like to thank all the panel members who took the time to share their perspectives and help define the important issues facing us in insurance as we seek to address climate change. Thank you as well to you, the audience members, for attending, learning, and hopefully bringing these issues and topics discussed at the C4I back to your teams, your employees, your managers, your families. If there is one takeaway from this, I hope it is a need for action, not just words. Recognizing the dangers we face is just the beginning. Now we need to act to address and to mitigate them. That is a challenge facing us all. Just so you know, this conference is recorded and it can be accessed on the conference website. We look forward to hosting this event again next year, where I'm hoping we will be able to discuss the progress we've made with new speakers, new information, and new data. Thank you for joining us today.